Sunbelt that where prices keep climbing, right? And then you, for example, Miami, where everybody's moving, right? Evidently, and then in New York, in San Francisco, the prices have fallen more substantially. It's really a muddied picture. Brookfield's Bruce Flatt comes out and says it's one of the best commercial real estate environments he's ever seen, even as you have others talking about the potential for significant increases in vacancies for office space. How do you get a clear message at a time of such change?
Kay Schiller, 20 cities is how you do it. You aggregate 20 cities. And John, we've come off my eyeball right now. I'm just doing it off smooth moving averages. And Kay Schiller's delayed old data, John, is 2-3 months behind. We've come back 80% from the peak. We were up 21. John, when you sold that condo downtown,
yeah, that worked
was
out.
A 21% pop. Okay? Right now we've gone from 22% down to 7% up. And we're on our way back, clearly on a vector back to under 5%.
Look at the Florida gains. Just going through our write-up of this story. Miami, total value of homes ballooned 20% year over year to $468.5 billion in December. Lisa mentioned other places: Northport, Sarasota, Florida, Knoxville, Tennessee, Charleston, South Carolina. Annual gains above 17% in 2022. It's a big difference, a major difference. Coming up shortly, Lara Rain of FS Investments. Futures right now inching just a little bit higher. We'll talk about NVIDIA later, which seems to be doing better than good, Bramo.
Chat GPT?
Is that what it's all about, AI?
Artificial intelligence. That's what people say.
Helping out the equity market this morning. More on that still to come. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. U.S. Treasury Secretary Janet Yellen says the global economy is in a better place today than many predicted months ago. In a press conference at the G20 finance ministers meeting in Bangalore, India, Yellen pointed to a resilient U.S. economy and moderating inflation. She also reiterated her calls for support to Ukraine as the one-year anniversary of Russia's invasion approaches. British Prime Minister Rishi Sunak suggested he wants to do something the European Union has previously opposed: make changes to the Brexit treaty. And that would be part of a deal with the EU over post-Brexit trade agreements to Northern Ireland. The British government says that the existing agreements hurts trade between the region and Great Britain. The value of the U.S. housing market has shrunk by the most since 2008. As you heard here on Surveillance, according to real estate brokerage Redfin, the total value of homes declined by $2.3 trillion in the second half of 2022. Now that's a 4.9% decline. The median U.S. home sale price was $383,000 last month, down from a peak of $433,000 in May. And shares of Rolls-Royce surged, the most in more than 2 years, after reporting earnings that beat estimates. Its new CEO said the UK engineering firm, which makes jet engines supplied to Boeing and Airbus, has underperformed financially for years and promised higher returns. Rolls-Royce will begin a strategic review to boost returns and resume shareholder payments. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
From the world of politics politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
It's fair to say that the global economy is in a better place today than many predicted just a few months ago. In the fall, many were worried about a sharp economic slowdown across the world. The challenges we face are real, and the future is always uncertain. But the outlook has improved since we gathered in the fall.
Fantastic to hear from Janet Yellen, the U.S. Treasury Secretary, who I wish we'd hear from a whole lot more.
Yes, where's the minutiae in her?
We don't. Equity futures look like this on the S&P 500, clipping a little bit higher this morning, ticking a little bit higher. Futures up, Tom, by 0.5% now on the S&P. On the NASDAQ, up by 8 or 9 tenths of 1%.
Let's steal 30 seconds from Laura Raim. Yellen on the next vice chairman of the Fed. I'm sorry, Biden, the president's going to lean forward and listen to his Secretary of Treasury.
Wall Street Journal reported yesterday, Austin Goolsbee was meant to be the pick, who's currently at the Chicago Fed. Democrats providing some resistance to that pick because he is a man, and they would like a female or a person of color. So the two names that are now linked with the job, considering Janice Eberly and Karen Dinan, two candidates to be vice chair. Eberly, of course, finance professor over at Northwestern, Tom, and Dinan, an economist at Harvard University. So they're the two names, according to the Wall Street Journal, that we're leading with at the moment for the vice chair.
For those that don't keep score on this, these are two individuals with prodigious skills. I mean, they've got major chops, but it's different chops than Brainerd. Brainerd is really focused on the public policy of monetary theory, and that's a little bit more focused on what the Fed does than maybe what they would bring to the table.
They both also have political histories, right, which is also interesting, given the fact that they've served in administrations before in other capacities. Yeah. Again, coming in at a real tenuous political moment, which raises the question of how much this Fed can really push back at a time when you start to see more pain that we haven't seen yet that might never come, but people are talking about anyway.
On the short list for Vice Chairman, Laura Raim joins us right now, Chief U.S. Economist, FS Investments as well. Laura, I want to go to a great phrase you've got on savings, momentum, and income. You have said it's going to be difficult to get to recession. Matt Lozzetti joins us later, who has called for a longer, farther out point of recession. And all of that, to me, hinges on what John Farrow just mentioned, which is housing. Does housing put us into recession?
This is actually a very unique business cycle, and I am happy that we're talking about housing because it's just one example of how no business cycle ever truly repeats itself. I think something when we look at the impact of higher rates, housing is clearly ground zero in terms of activity. But when you look at GDP, when you look at the things that the Fed is really monitoring when they think about recession, employment's one of them. And we often think that when housing falls like this, you would see a lot of layoffs in the construction sector. And we haven't seen that really. So it's just one small example of how the dynamics this time around are really different. The labor scarcity that you're experiencing in construction remains. A lot of these projects have long legs, and maybe they were put off a couple of years ago because they couldn't even find the products to actually build these homes. That's a little bit of a cul-de-sac, Tom, but it's just a way to say that, you know, in every recession, we go into it thinking, you know, looking at our prior business cycles, pulling out the playbook, and you just really have to rethink it every time. And that's why, you know, we have to think about what the Fed is trying to accomplish. That is to slow the economy down, and our economy naturally wants to grow. It needs to kind of break something to get it off those growth rails, and we still haven't done that yet, even with such a big hit to housing that I think we all feel.
Well, the famous ROM GDP Now index, everybody looks at that. Where's the momentum right now, Laura? I mean, are we going to do a Q4 equivalency forward in Q1, Q2, Q3?
It's still based in consumption. An unemployment rate at 3.4%. We're going to get the personal income and spending data, you know, later in the week. but the income data are just not going to really or they're not going to fall until we get some meaningful change in employment. And with a 3.4% unemployment rate, you just don't get a recession. They need to move the needle on employment as part of their inflation wage goals, and getting those back to 2%. But for now, I think you're just continuing to see that momentum coming from household spending, which is much more income-based than wealth-driven.
Laura, how much do you have faith in the long and variable lags to think that perhaps we just haven't seen the effect of the rate hikes, and that if the Fed doesn't hike rates further, leaves them where they are, it'll be enough to bring down inflation?
Well, this is one of the paradoxes. You fixed the mortgage market, which was the problem of the last business cycle, and now you've kind of taken that piece away from monetary policy with homes and mortgage prices, mortgage payments locked in. You're just not going to see monetary policy have the immediate impact on spending like you did during the 2005 rate hike cycle. So, I'm not saying that a recession's a foregone conclusion. I think the GDP outlook for 2023 remains stagnant, probably 0.7 for the entire year. The first half of that, probably 1.5% growth. But at the end of the day, you're really seeing an economy that is grinding along, and the Fed is going to continue to have to push against a lot of momentum that plays out over quarters.
Well, this raises a specter of potentially much higher terminal rates than people expected, especially the lack of sensitivity in areas like housing. How much have you ratcheted up your expectation from perhaps not the Phillips curve kind of models that people are talking about with 8% types of terminal yields, but something above that 5.5% that the market's gaming out?
I mean, Lisa, it happens so rarely that I'm right that I have to crow when I am, but I've been saying for a long time that I think they're going to have to go above 5%, as high as even 5.50. I think, that has been something that has been clear because, while they absolutely need to slow the pace of rate hikes, they were basically raising rates with their eyes shut last year. They need to now be a little more thoughtful, be more methodical. But the economy had so much momentum going into it. And I think, also fighting against these market expectations of rate cuts, which I think they've very effectively done. And the markets have, I think, had to come to terms with the Fed's, really this time around, strong sentiment that they are going to need to stay higher for longer.
I think the data changed that conversation, not the Fed speak, the data from the start of the year. We've been talking about residential real estate. Laura, can we talk about commercial real estate just briefly? We had this headline, this story in the last 24 hours, that an office landlord controlled by PIMCO has defaulted on about $1.7 billion of mortgage notes across 7 buildings. Laura, what's going on there?
Commercial real estate is also interest rate sensitive. So we're going to see some of these valuations be impacted. Remember, there are just so many fewer data points, and the data is lagging in that sector more than it is for the residential sector. So I think we're going to start seeing headlines like this, but it is a sector where you're seeing such diffuse performance. We know that office space is going to be challenged, especially in the major metropolitan areas. But that's why, I think for investors, we need to look in other areas. We need to look at industrial. We need to continue to look at, to some degree, even Sunbelt states regionally. We need to look at multifamily. I think there are a lot of areas where we've continued to underbuild in this sector since the Great Recession. So there's still a lot of room for returns there. But at the end of the day, you just need to access that differently. It's not a sector that I think we're going to see as uniform move in valuations as we have seen in residential real estate.
Laura, this was great. Laura Raymer of FS Investments, thank you. Those buildings in San Francisco, New York, Boston, New Jersey, owned by Columbia Property Trust.
I read every word of the article. I read every single word of the article. This is a huge deal. If you say to me, what have you changed your focus on in the last 90 days? I'm reading about commercial real estate every single day, 20, 30, 40 minutes a day. I literally ran into the street, John, on a major New York commercial investor, and he grilled me for 20 minutes in chit-chat about Class B, Class C properties. He said it's the same or worse than 07.
That's the key, though. The Class B, the Class C,
Yes.
and this bifurcation
That's what
between the
he said. That's not
desirable
what I said.
and the not desirable property. And that's what I find interesting. Cushman & Wakefield put out this report saying that hybrid working will cause vacancies in offices to rise by 55% versus their pre-pandemic norms. And by 2030, and if you take a look at that, where is it going to be? It's not going to be in all commercial property. It's going to be in the
key
ones
thing,
that are
John,
updated.
to that great article with the PIMCO challenges is it's multi-city. It's not just about the
Yeah,
selfishness of the island of Manhattan.
That's a good
It's out
point.
there.
Should we have dual salaries? Should we do that? For the people that come to New York, you get paid more. And if you stay at home, you live in a cheaper place.
Third rail, John.
Okay, can I just
You
say
get paid less.
Third
that's
rail.
been an issue, but I am wondering whether a change in the economic circumstances will change the view in working in the office versus at home.
There's no bias here at all.
Yeah, what are you lobbying for now?
I'm with you. If you get a softer labour
Yeah, yeah.
market, that anxiety
Yeah.
creeps back in,
All of
you
a
show up
sudden.
in the office. Maybe.
With a suit.
Gin and Emmanuel, up next.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg. Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What I'm following right now, also cash on the sidelines, money has to be put at work.
You're looking at an environment where the Fed does need to be tighter.
If I was them, I would pause and see what they've gotten done so far.
We do think that the economy will slow and will continue to slow from here.
I think that inflation can come down even if the economy doesn't land.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Did you pour your coffee all over your terminal?
No, it's
Is that
Tang.
what you've done?
No, the Tang.
Because
It's
that
sticky.
absolutely stinks.
The Tang Zero is not as
Can you
sticky
smell
as the
that?
Tang, but you know.
I'm fully removed.
Wow, from New York City this morning. Good morning,
Good morning.
For our audience worldwide. This is Bloomberg Surveillance on TV and radio. A wise man said to us a number of weeks ago, if you're not paying attention, if you're not confused, you're not paying attention.
Yeah.
That was Julian Emmanuel of Evercorn. He joins us around the table. We're going to catch up with him in just a moment. Futures up by about 0.5% on the S&P, Tom, coming off a 4-day losing streak and trying to bounce.
Exactly, trying to bounce. NASDAQ 100 up 0.9%, trying to bounce. VIX comes in 23 to 21, breaches 22, 21.86. But I think it's right. Trying is the right equity energy this morning.
And keeping one eye on the bond market, maybe two.
Maybe two.
All morning. Yields pushing higher again, Lisa, approaching the highs of the year.
And it's not just absolute nominal yields, but you're also looking at real yields. The 10-year real yield hitting the highest level of the year, basically going back to early January. At what point have we gotten the full reset in stocks that we're feeling in bonds? Have we priced in the full pace of rate hiking, even with some of the recent weakness?
Let's whip through these markets. I don't want to leave you waiting, Julian. Just, itching to speak to you.
We left that high.
Futures look like this on the S&P 500, up 0.5%. Yields coming up a couple of basis points, 393.91 on a US 10-year. And euro-dollar early this morning, if you're just tuning in, Eurozone CPI, Lisa coming in at a record high on core.
And revised upward after the German mystery figures that they got in. Here's what we're looking at today. 8:30 a.m. we get U.S. initial jobless claims plus the second read of the fourth quarter GDP in the United States. Initial jobless claims expected to come in still near historic lows. Again, where is that loosening in the labor market that a lot of people are asking for? It has not shown up yet. At 12 p.m. we hear from U.S. Commerce Secretary Gina Raimondo. She's talking about chips. She's talking about developing more technology in the United States. I want to hear what she says about China. Will that be in the speech, or will that be the subtext that we hear basically under a lot of the innuendo that she discusses? And today we hear some more Fed speak because we get, it's another day that's not a quiet period. Atlanta Fed President Raphael Bostic is speaking at 10:50 a.m. San Francisco Fed's Mary Daly at 2 p.m. Is Fed speak taking on less importance, John, at a time when the data is so confusing and it all is about the data, not about the nuances of which member and what voting pattern?
Without a doubt, it's the data that closed the gap between the Fed's projections and where the market was at the start of the year. They can talk about not cutting all they like. Ultimately, investors kind of understand the reaction function of the Fed and have responded to that economic data, payrolls, retail sales, CPI, PPI, take your pick, and push the terminal rate higher.
Well, and the reaction function, let's be clear, has kind of shifted a little bit over time. So there's this issue of, okay, inflation's number one, but people are basically believing that the Fed will be more hawkish if the data is more aggressive, and they won't be if it won't, period.
What happened to the disinflationary process starting? I didn't see it anywhere in the minutes.
Maybe it's already ended.
It's kind of bizarre, isn't it? Usually the chairman's meant to reflect the consensus, whatever that might be, on the committee and the news conference, and then if he does an interview somewhere or testifies, he can talk about his own thoughts on matters. That performance in the news conference sounds even stranger now, going over those minutes from yesterday.
I would agree. At the same time, I wonder how much the disinflation was his. I hear Julian Emmanuel laughing, but you're raising a great point. Was that the massaging to take out all the disinflationary talk? Or was that a Jay Powell issue and not necessarily a committee issue?
Okay, Julian's with us. I've said that 4 times, so hello, Julian.
Good morning.
Well, we should just start with you straight away. Do that more often. You've got a line here in your research that says the path to our year-end 4150 price target is lower than higher. Why is it lower than higher?
So if you think about coming into the beginning of the year, there were 3 reasons the market had done as well as it had done until a week and a half ago. Number one, the positioning was incredibly bearish. We all knew that. There was epic tax loss selling, which is why the stocks that were the biggest sellers, the ones that really had the weakest performance, are all the ones that rebounded. That's been neutralized. The second thing is, as you alluded to a moment ago, is inflation. The benefits of the decline in inflation, we're now at the bumpy path, and the question is, are we plateauing? We don't think we are, but the market has discounted the benefits of the initial fall in inflation. And then, of course, the third element here is this whole idea that the combination of the inflation reaction and the price action in the equity markets themselves have caused people to believe that the soft landing is now the base case. So back at the end of the year, December, remember, the market was falling apart. Everyone was kind of pessimistic. 80% chance of a recession in the next year. We think that number's around 30. You look at New York Fed measures, that number's closer to 57. So that to us is over-discounted, whether it happens or not. It's over-discounted, and this is a probabilistic world, so we do think that the path has shifted to potentially lower before we start moving on.
Benjamin Nabarro at Citigroup talks about United Kingdom disinflation, like Ed Hyman of Evercore ISI talks about U.S. disinflation. What do stocks do if we get Ed Hyman's sub 3% disinflation?
So in the long run, that's going to be extremely beneficial. But I think, again, part of this environment is parsing between the short run, the medium term, and the long term, with the short term having been this incredible rip in the stocks that were most sold over the last several weeks. We would say in the medium term that a consequence of inflation starting towards that path is going to be the growth slowdown that, frankly, the Fed wants, because that's how the labor market cools off. And then ultimately, when we get to that point, that's when the benefits of inflation kick in, lower inflation, but that is often into the future at this point.
Let's translate this into a stock market call. Given the fact that at the end of last year, a lot of the pessimism came from this expectation of margin compression. We've gotten earnings, massive margin compression. Why has that not been priced in more significantly?
Again, and this is something that we all talked about very frequently last year. The price action sets the narrative. So you had 2 consecutive quarters of EPS reductions, and the stock market rallied in the face of that. And so given the positioning and the price action, there is a tolerance for it. But from our point of view, this whole idea of multiple expansion happening before the economic downturn, however shallow, and we do expect a shallow downturn, doesn't really add up. We'd rather see that multiple expansion coming out of the short and shallow recession that Ed Hyman is forecasting.
A number of years ago, Julian and I went for lunch. I believe it was Greek food. It was very good. And he said to me, John, you need to be watching what's happening with volatility. And then we had Volmageddon in early 2018.
And again now.
And now there's conversation of Volmageddon 2.0. Bank of America say that this warning of Volmageddon 2.0, which was presented by Marko Kolanovic of JP Morgan recently, B of A said it's overblown. Can you talk to us about what that so-called Volmageddon 2.0 might look like and whether that warning is overblown?
Overblown to the third power, in our opinion. Okay, here's the setup, right? What 0 days to expiration options do is actually increase volatility intraday. But if you look at the last several weeks, it's decreased it intraday, right? So basically, you have zigs and zags from 9:30 till 4 o'clock that at the end of the day, because the options expire, it's all neutralized. And that is a recipe for books staying balanced, no forced selling, no forced volatility squeezes. It's not going to happen.
You could lecture on that at San Diego. I mean, they're the land of this. Statistically, that was brilliant. Intraday, it drives me nuts how people conflate intraday vol with interday vol. Let's take it out longer. When will you know that Ed Hyman's right about disinflation? You read his report just like we do. He said he planted you at his office, like back. You're so far back in the cheap seats, you're looking at, Brooklyn and Queens. But when you finally get to read Ed's report, how do you distill the when of it? When do we get that disinflation?
Well, we actually think it is still part of the subtext right now. So
I agree. I'm just asking.
Our proprietary surveys are showing that actually some of the shelter costs are continuing to subside, contrary to what we saw last week from the Fed's, the shelter component in CPI. We're seeing wages really start to moderate. They're still elevated, but all of this really, in our view, and the goods part, we all know. That's well known. So frankly, I think it's some of the more, the monthly data has got another month or two of choppiness, and then I think you're going to continue to subside, perhaps more gently than you have.
John, the pros on this, and I learned it from Ed Hyman. He was at a firm called, you weren't there, you weren't at C.J. Lawrence, were you? Hyman was at C.J. Lawrence, and he's screaming about 3-month annualized. We look at month over month, and granted, that's important now, or year over year, and there's different ways Britain calculates it different than we do. Adults look at the 3 months of data and then annualize it out. And those numbers on inflation now are not in the perception of the market. They're low numbers.
Well, they looked better a couple of months ago than they do now.
Yeah, I mean, I just looked at the 30-year mortgage rate, and I was going to buy, and I can't.
Julian, how busy is the office at the moment? Are people coming in? We want to know.
Yeah,
is it getting busier? Is it a 3-day week, a 4-day week?
It has been consistently a 4-day week, and I think there's a little bit more crossover there. But the really good thing is that the client engagement is better. I've got a full travel schedule in March, and I think that's very encouraging.
So you're traveling below 59th Street?
Below and above.
Oh, very good.
And on planes.
Are you finding that you're more productive post-pandemic? Are you seeing more clients than you did pre-pandemic just by not being in the office so much? How's it working out?
Well, Zoom is a remarkable thing. You know, you can go back to back to back to back, but again, maybe it's old school, whatever. There's no substitute for in-person.
Hold on a second. John, you're just steadily arguing for a 4-day work week. No, do you find that you're more productive?
What are you suggesting?
You're basically saying, that people, should be allowed to have either a 4-day week with.
How dare you say?
100% that's what was going on.
How dare you?
Don't you think that you're more productive in general?
How dare you? Maybe I am. Gillian, thank you.
Thank you.
Good to see you, buddy, as always. Gillian Emmanuel of Evercore. Sam Stovall's coming up in the next hour. We'll ask him about a 4-day week. From New York, this is Bloomberg.
Four-day week sounds pretty good. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Core inflation in the Eurozone set a record last month, and that probably cements the European Central Bank's plan to raise interest rates by another half percentage point in March. Core price gains reached 5.3% in January. Headline inflation, which includes food and power, was up to 8.6%. The minutes from the last Fed policymakers meeting shows that the central bank is inclined toward more interest rate hikes to curb inflation. Still, almost all officials back slowing the pace of increases. The market indicates that 25 basis point hikes are likely coming at the March, May, and June meetings. President Joe Biden says Vladimir Putin has made the world less safe by suspending participation in the New START nuclear treaty. Still, he told ABC News he doesn't believe that means Russia will use nuclear weapons. The treaty seeks to limit the deployment of intercontinental range nuclear weapons. India is hosting the G20 finance chiefs meeting this week. Bloomberg's learned that officials there want to avoid the use of the word war in any joint statement referring to Russia's attack on Ukraine. Instead, the word crisis would be more acceptable. That would be a change from the consensus reached by the G20 leaders last November. And Tesla is placing its global engineering headquarters in Palo Alto, California. CEO Elon Musk appeared alongside Governor Gavin Newsom at the announcement. It's a sign of renewed cooperation between the electric vehicle maker and the state that Musk scorned the last few years after moving its corporate headquarters from California to Texas in 2021. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Today, the global spotlight is on India as the G20 financial leaders gather. Among the issues on the table, debt relief, inflation, climate sustainability, and more. Live coverage continues on Bloomberg, your global business authority.
We're kind of getting back to a more normal labor market, believe it or not. I think labor is going to find that there is a limit to the extent to which wages are going to be raised by companies. And I think that's because the companies are starting to run into resistance from consumers to price increases.
Ed Yardeni of Yardeni Research, at the start of the year, he came out with a report in January and said, soft landing, hard landing, no landing. And a lot of people have started to say the same thing based on the data we've had between the start of the year and now. Equities at the moment up 0.5% on the S&P 500, on the Nasdaq pushing higher as well. We'll get to the why in just a moment. Yields are a little bit higher by 3 basis points. Your 10-year still just short of 3.95, but getting closer. Your 10-year 3.94.49. We can get to the why just quickly, Bramo. Nvidia in the pre-market. Doing pretty well.
Yeah, it's all about, I guess, not necessarily ChatGPT, but artificial intelligence and an investment there, and how much is that going to sort of revive hopes? It's sort of like artificial intelligence is the new cloud computing. I mean, are we entering a phase where that's going to solve everything? We are seeing a huge pop in Nvidia shares, almost 10%.
Makes up about 4% of the Nasdaq 100, for anyone that cares. Stock's up by close to 10%, and Tom, that would be why your Nasdaq is doing pretty well this morning off the back of it.
Yeah, I think so. I think NVIDIA is the most misunderstood of the great tech companies, 22,000 employees. How about 50% a year per year for the last number of years? It's been a moonshot. It stays a moonshot. And I think all in all, it's lesser understood. But the major thing is it's well run and it does what people want, which is gaming, music production, all that on monitors that need fancy stuff.
Can you just clarify? NVIDIA?
NVIDIA is what I call it.
NVIDIA.
You know, I don't know.
NVIDIA.
I don't know.
NVIDIA.
No, it's NVIDIA. I'm just
NVIDIA.
making it up. Yeah.
NVIDIA.
Mandeep Singh's going to tell you which one.
Yeah.
At the moment.
We're going to get to
He's
that.
exciting that.
You know,
Sorry about that.
Mandeep Singh with us right now, and he's just done such a great job of helping us with the layoffs in technology. And the layoffs, I guess, aren't at NVIDIA. Naomi Nix, Mandeep, stopping traffic for the Washington Post in the last 24 hours. And the first thing I thought of when I read her article was you. And that Zuckerberg is going to flatten management at Meta. I find that extraordinary. Is technology becoming like regular businesses?
Yeah, and look, I think a company like NVIDIA kind of allows every company to use AI or, you know, just the next generation of chips. I think what they have done remarkably well is you know, they've gone from one secular trend to another, whether it was cloud or metaverse or crypto to now AI and, you know, generative AI. And that's what shows you the power of, you know, semiconductors. We talked about Moore's Law for the longest time. Now it's more about accelerators. And I think what Meta is trying to do or what other cloud vendors are trying to do is to make sure that they have that computing capacity to stay ahead, you know, in terms of the scale and the amount of data that they're dealing with.
I mean, what they're talking about is de-managing managers down to, I'm going to call it staff. With Meta, with Facebook, it's 86,000 people, and I don't know what percentage they'll take. But Mandeep, you look at that, and you look at the unrest at Amazon, where Jossie's saying you got to come back to work. I'm sure at NVIDIA they're saying the same thing. You got to come back to work, and people are going to revolt. Who's going to win this power play between the employees and guys like Zuckerberg?
Well, so one thing we know is even though, remote work is sort of something that was forced by the pandemic, it's not going away completely. And that is where I think the nature of jobs will evolve, how you go about doing your work will evolve. And I think AI and technology has a big role to play. I mean, we talk about how much productivity you can drive through, Zoom. And that is where you have to think about generative AI or, whatever next comes in terms of faster processing of data, large scale processing of data. And I do think, some jobs will get automated, but also there will be a productivity boost. And that's why all these companies are very important in terms of what they're trying to do. Whether, it will be more applicable in social media, time will tell. I think social media is just one of the use cases of AI and what's going on in the semiconductor world.
Mandeep, let's talk about ChatGPT and just how evolved it is. So evidently Microsoft has eliminated some of the emotional responses to people. And just to give you a sense, on February 17th, they started doing this after some of the responses included comparing a reporter to Hitler. Another response to a New York Times columnist said, "You're not happily married, and actually you're in love with me." What is the development here? I mean, how advanced is this?
Sounds like John's
So you have to think. You have to think about how these models are trained. And although we're talking about petabytes of data now, this is 1,000 or 10,000x more than what we were able to do last year. So clearly, the ability to train algorithms and models on large volumes of data is there. Now, how accurate it's going to be, it'll be iterative. I don't think any chat or, some version of a bot that comes later will be accurate in the first iteration. And that's why AI is iterative, but what you need for those iterations is processing power, large amounts of data. We're talking about full-scale language corpuses being used to train these models. That's huge. I mean, think of, yes, it got it right the first time around, but once you, figure out what the right way to answer is and, you train that algorithm to do that, I think it's going to improve at a very rapid pace. And that's what you're going to see, over the course of the next 2-3 years.
Which chip makers are on the front foot when it comes to this and which are not?
So clearly, AI does involve a lot of accelerated processing of data, large-scale processing of data, and that's where NVIDIA clearly is the leader, and that's why you see so much, excitement around what they could do on the data side. They built this data center business from $3 billion to $15 billion over a span of 3 years, 50% CAGR. Now, they could keep doing it if the market is moving away from Intel, which we know it is on the CPU side, and every data center requires a lot of accelerators. That's huge. And that's why, you see that excitement. There are a lot of other smaller chip makers that enable AI as well. It's not just NVIDIA, but you have to think about networking aspect, cloud aspect, and then accelerator is the highest ASP component when it comes to AI processing.
Mandeep, thanks for being with us, as always. That stock's flying by close to 10% in the pre-market. Mandeep Singh there of Bloomberg Intelligence. A viewer, a listener, asked this question of ChatGPT just moments ago. Is Bramo a pessimist? From the response. From the response.
Yeah, please do.
Okay. As an AI language model, I cannot make subjective judgments about Lisa Abramowitz's personality or outlook on life. However, based on her professional work as a financial journalist, it is not accurate to describe her as a pessimist.
It's true.
Goes on to say, while Abramowitz may report on potential risks or downside scenarios in the markets, it is important to remember that this is a fundamental part of financial journalism.
Wow, I love ChatGPT.
There you
That's
go.
so sweet. That's such an accurate
That's as close to
description.
It loves you
John,
too.
that's as,
Evidently, although I can't talk about
Wait a
emotion.
Is that our new publicist?
That's it.
Exactly.
That's it.
It's going to be this. Well, I mean, that's fantastic. I love that.
There you go.
Can
You're
I-
lost for words now.
I'm absolutely lost for words. Thank you. I'd like to thank
We're talking
the people who got
we're talking disinflation here, and all the economic reports are going to come out, and sometimes the anecdotal matters. And John, we have a reporter in London, Francine Lacroix, who is expert at the Italian as you, and she just put out the inflation of a pizza in Italy. And I went, and Bloomberg actually has an olive oil pricing. Olive oil, off the moving average of the pandemic low, has increased 157%.
Wow.
So have some other ingredients as well. And Francine doesn't think she's going to be able to get on in life. Italian olive oil up 157%.
Francine's from Liguria. They do half decent olive oil over there.
Yeah, I don't know. But,
That's about the nicest compliment you could ever make about anything.
For someone whose family's from
Exactly.
Puglia.
Where is the
Clearly.
best Italian pizza? I mean, is there like a pizza capital?
Well, they would
Naples?
say Naples, yeah.
Naples?
I mean, you would say Naples, possibly, sure.
Okay. That's something you can use.
I liked what was called a panzerotti.
What's that?
It's it's like it's like a pizza but fried. You know, have you ever had a calzone?
Yeah.
Where it's sort of like a pizza
we
folded up.
Americans
It's a
are
little
familiar
bit like that, but much smaller, and you deep fry them, and you can have them savory or sweet. They're very, very good.
That sounds
They're very good. You used to get them on a tray.
You know, I like in Rome that you can buy pizza by the weight. You can get it cut, and then you buy it by the weight. So you can say, I want that little slice over there, like fish.
Oh, you mean? Oh, okay. I've not seen that before.
Really?
Interesting.
Yeah.
Oh, nice.
The more you know.
Where did you go?
I went in Rome.
Yeah.
Well, there were
Do you remember the
neighborhood.
restaurant?
It was no, like a standing place
Oh,
where you
right.
go.
Cool. Sounds nice.
Great.
Lisa. Thank you.
Travels with Lisa.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
The top names at the Fed are on Bloomberg.
Inflation is normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far. But if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Equities trying to bounce here and doing just that on the S&P 500. We look a little something like this. Equities up 0.5% on the Nasdaq 100, up almost 1 full percentage point. On the Nasdaq, the fourth biggest weighting, NVIDIA. That stock is up in a pre-market by more than 10% now off the back of earnings. That's quite a move. We'll pick up on that later. In the bond market, 2s, 10s, 30s. Your 2-year, 470. There we go. Yields back up just a little bit by about a basis point, getting closer and closer to the closing high of this hiking cycle. Going all the way back to 2007, we closed a little bit earlier this week at 472-ish on a 10-year, Tom, just short of 395 on a 10-year maturity.
You mentioned payrolls in March, and we're starving for data. I mean, this is a market of ambiguity and complete uncertainty, and we're all slaves to the data. I mean, how big is claims today? 194 is the fiction we had last time. Once again, we survey up to 200,000.
200K, which is still exceptionally low.
Are we going to see another, 196, whatever? And the revision, I mean, I'm sorry, at 8:30, there's all this noise, but it's still Thursday, 8:30. It's claims Thursday.
You mentioned March 10th. It's not just payrolls. It's the BOJ that day as well. Kuroda's swan song.
Yeah, Kit Jukes was brilliant on this today. Did you see Kit's note?
I didn't.
Well, I think this is important in that there's like testimony. I've had the honor of observing the process, which is totally different. Nobody has a follow-up question in Japan. Nobody has a follow-up question. And the bottom line is, this is original, and it will be measured, and we may not get much news out of it, but there's an immovable force there. Kuroda wanted inflation. He got inflation. Now what? And that's the question.
Now what in the bond market as well? Because if you look at the 10-year maturity on the JGB curve, you'll notice that it's bumping up against that 50 basis point line of the sand, which is the threshold for yield curve control. Breached it a couple of times as well, and they've had to come into the market and clean it up.
They need ChatGPT.
Is that what they do?
BOJ needs ChatGPT. It'd be perfect.
I want to finish on foreign exchange. Had some data out of the Eurozone a little bit earlier this morning. Record high on Eurozone core CPI, Euro dollar. Trying to strengthen here at 106.15, but we had a break at 106 in the last 24 hours to 105, Lisa. 105, the first time we've seen that in the past 24 hours for the first time since the start of the year.
A complete reset in terms of where the Fed has to go. Can you imagine if Kuroda gets up there and just says, it's over, yield curve control.
Mic drop.
Mic drop, goodbye. I think that a lot of people
for the next guy.
Yeah, exactly. Well, I don't think that's going to happen. Anyway, let's take a look at some stocks that are moving. NVIDIA, we were talking about those shares popping more than 10%, 10.5% about in pre-market trading. How much is this just in terms of the bearish expectations before the earnings results, and how much is this AI becoming the new cloud computing? I mean, how much is that really going to drive some of the optimism around the chip story? You look skeptical, Tom.
I don't agree with any of this. AI, yeah, you can do the AI thing. Free cash flow, 2019, $3 billion. Modeled free cash flow out 5 years. $10 billion. I
think that goes beyond just being skeptical.
To $10 billion.
Like, I don't believe
anything
you're saying.
3 billion to 10. This whole AI thing, baloney. These people are a financial machine. They're bringing on EBITDA. Oh my word, they're off the mark. 38%.
Why are they bringing in that money? Because they are selling chips that provide some of the capabilities that a lot of these companies want to do. We can debate it in the break. I want to get to some of these other names. Dollar General, which is decidedly not artificial intelligence. Those shares are lower after reporting earnings this morning. Those shares down about 5.5%. What's interesting to me is you can blame the weather for the strength in the economy. You can blame the weather for the weakness in the economy. Dollar General saying that its earnings disappointed in December because of the storm. How much is this going to be an indication of either people pushing back, margin pressure? I'm going to have to dig through and really understand this, because when people start blaming the weather, I start to get skeptical as well. Tom, just like you.
So was January better?
Well, they do expect January to be better because they're expecting same-store sales to rise by 6.5% versus 4.5% in December.
Okay.
That said, let's see. People don't seem to be buying the optimism with those shares lower by more than 5%. And Wayfair, it's this online furniture company, right? On one hand, you expect them to do poorly in light of some of the weakness that we've seen in goods, with the weakness, et cetera. But they beat on revenue. But they posted a bigger loss, and they saw subscribers decline. Those shares lower by about 1%.
What do you subscribe to?
I don't really get that either.
I don't. I've been on the website.
I think that it's you subscribe and you get
better
benefits and delivery.
And
prices. It's like Prime. I mean, they're basically talking about the
Prime for Wayfair.
I don't get it. I tried it. And
I get lots of emails from them. I think I unsubscribed.
Yeah, exactly. Exactly. Stock has gone 50 to 350, pandemic high. It's only down 85% from the pandemic high.
Can I just point out that basically movers that we talk about, it turns into me being like, this is the story. And Tom's like, I don't buy a thing. That's literally.
We just start talking about our own
I think
lives.
NVIDIA gets no love.
100%.
NVIDIA gets no love. It's Apple, Google, Apple,
tons of love.
Meta. And I just think the media doesn't give them the love they deserve because, they're a little bit different and they're smaller.
I disagree. Love.
Thank
you.
Oh, that's what Gorgieva does. That's what Gorgieva.
Perfect.
That's the managing director of the IMF. She's very good at when she disagrees with me.
Nice.
I get this.
That works really.
I'll start doing the same thing.
That works really well on radio.
Just do a Gorgieva, Bram. That'll do
Thank
it.
you. I appreciate it.
Thank you, Lisa. That was great.
We survived that? Okay.
55 minutes away from jobless claims in core PCE for the fourth quarter. RJ Gallo of Federated weighing in on the strong
He's
data
still
we
there?
had recently. I hope. But here's a quote from him. The research and data enhances the prospect of the Fed holding its target range at above 5% for longer, thus increasing the chances for recession in the future. This is kind of the issue for a lot of people in this market. The data's good, so rates are going to be higher for longer, and then ultimately, Tom, we get a recession that might be harder in the future. This is a problem for a lot of people in this market, TK.
It is, and we're going to speak now to RJ Gallo. I should point out Federated Hermes has been hugely valuable to us. Some great perspective there as well. What have you changed, RJ, in the last number of weeks? Is there a reset from year end, or is it steady as you go?
Well, it's a great question. The month of January, the bond market got off to a tear. The Treasury index by the end of the month was up around 3% total return. Very impressive. And then you get to February, it's the complete opposite image. The Treasury index is basically down to flat. Yields have risen almost 30 to 50 basis points across the curve. Why is that? I think Jonathan touched on it earlier in the show. The data stream has been undeniably strong on services, on jobs, on retail sales. Consumer strength is resurgent, gives pause to the idea that we're going to have a slowdown in the near term. Our view, however, is this just gets the Fed to be more hawkish, go a little higher, hold a little longer, and that sows the seeds for the growth slowdown, perhaps mild recession that will make bonds perform rather well as you look out over a year, 2 or 3 years from today.
Years ago, you were at Columbia University in the trenches of actually managing money. If we get price down, yield up in the total return index, a Bloomberg total return index breaks through to new price lows, or the 30-year mortgage as a benchmark goes out to new highs, how will investors respond?
Well, those years at Columbia, I was working in the endowment office. I was a junior investment officer on the endowment team, very junior, I might add. Still in the trenches now as a senior vice president, actually managing portfolios. And it's interesting that you raised that date. Back in the early 90s, when I was at Columbia, we had the 1994 tightening, and it felt terrible. It felt terrible. Stocks struggled, bonds struggled. It was nothing compared to what happened in 2022. The double-digit losses across basically all of fixed income were astounding. And I think that recreates value. Right now, the market has become addicted to the idea that duration equals fear. I think we need to turn the page on that. Sure, January was a little bit of too much enthusiasm in the bond market, but when you have the aggregate yield over 6.2%, or excuse me, over 4.7%, and its duration is 6.2%, you now have income to support total return. The yield would have to back up 75 basis points before you're even at zero total return. That's a very different bond market world. We think investors need to back away from their fears and start edging out the curve rather than holding on to cash and worrying about the next rate spike.
Is it the cash that you're putting into duration, or is it some of the risk portfolio as you expect the Fed to hold rates higher for longer?
Well, it's a great question. I would suggest that investors should do a little bit of both. Then our total return bond fund, multi-sector, spans across the curve, spans across sectors and fixed income. We're actually overweight treasuries and underweight high yield and investment grade corporates for the exact reason you just mentioned, Lisa. We are of the view that asset allocation still matters within fixed income as well. So it's not just moving some of your cash into bonds, it's how are you allocating within bonds. And our allocation within bonds is up in quality. We are cautious that the ultimate slowdown that the economy will experience as the Fed's cumulative tightening takes hold will take some prisoners, if you will. It'll dent corporate profits, it'll widen corporate spreads, and we'll see underperformance in investment grade and high yield. So we're remaining underweight until we see wider spreads and better opportunities there.
I get the argument, RJ, for income in the Treasury market. I think we all do. This is really interesting stuff. What I struggle with at the moment in the near term, RJ, do you think we just have to carry on tolerating the positive correlation with equities that we're seeing play out?
I like the word tolerating. So I'm a co-manager on a balanced funds. It's munis and dividend-paying equities. And we came out with it back in 2003. And one of the underlying arguments for investors is the inherent risk reduction from the diversification between the muni fixed income side and the equity dividend-paying side. And it worked for decades plus until it didn't. You mentioned, Jonathan, that that correlation has been brutal. Certainly was brutal last year, 2022. Stocks down like 18%, bonds down double digits. And there was some hope as you turned the calendar into 2023 that we would get back to more normal markets where risk on and risk off meant that the assets moved in opposite directions, not together. February has been a bit disappointing because we've restored that positive correlation where stocks down, bonds down. I think ultimately higher yields and a Fed that is closer to done with its tightening than starting its tightening suggests that we are getting back to a period where that correlation will return to more normalcy. It's hard on investors. A friend of mine who's a financial advisor to individual investors said he spent a lot of time on the phone last year explaining to individual investors why their 60-40 portfolio was down almost 20%.
Yeah.
I don't think you're going to have that experience this year. The returns from fixed income are apt to be significantly better. Stocks, I'm not an equity guy, but I think that the equity market has been a little bit too buoyant with respect to what's happening on inflation. It's gotten choppy again, and we'll see how that turns out.
It's never stopped the equity guys commenting on bonds, RJ. You know that.
I know.
They love to do that. RJ Gallo of Federated. RJ, thank you, sir.
Very true.
As always. That's not the story today. Yields are up, treasuries are down, and equities are doing okay. On a 10-year, we're high by 3 basis points, just short at 395. Coming up on China, Leader Miller at the China-based Book International. That's next.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. U.S. Treasury Secretary Janet Yellen says the global economy is in a better place today than many predicted months ago. In a press conference at the G20 Finance Ministers meeting in Bangalore, India, Yellen pointed to a resilient U.S. economy and moderating inflation. She also reiterated her calls for support to Ukraine as the one-year anniversary of Russia's invasion approaches. Bank of England policymaker Catherine Mann has dismissed talk of an upcoming pivot to easier monetary policy. Mann spoke at the Resolution Foundation in London.
Given that the risk of increasingly persistent inflation rises disproportionately, that's that nonlinearity, with the share of backward-lookingness, I believe more tightening is needed.
Consumer price growth in the UK remains at around a 4-decade high of 10.1%. And here's a different view of that Chinese balloon that flew across the United States. It was taken on February 3rd from the cockpit of a U-2 spy plane at an altitude most likely above 60,000 feet. A day later, another U.S. plane flew near the balloon off the coast of South Carolina and shot it down with a Sidewinder missile. Shares of NVIDIA are higher in pre-market trading. The company came out with a bullish revenue outlook suggesting that its push into artificial intelligence computing chips is paying off. NVIDIA also announced it is starting its own AI cloud service. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
That will be a big and serious mistake by China if they start to provide a lethal aid to Russia. So far, we haven't seen that happening, but we have seen signs that China is considering to provide military aid to Russia, and we are watching closely. And of course, China should not do that.
It's a major concern for NATO members. That was Jens Stoltenberg, the NATO Secretary General. This off the back of comments from the State Department spokesperson, Ned Price, just yesterday saying, we have not yet seen the PRC provide Russia with lethal aid, but we don't believe they're taken off the table either. We are concerned. TK, I think a lot of people are concerned about that issue.
A movable feast for the Allies, and of course this with President Biden returning home. I believe Anne-Marie Horton will be with us tomorrow from London, which is good, with Maria Tadeo as we look at this 1 year of agony with this war in Ukraine. I would suggest, John, there's value in the markets, and the value is EM is slipping away. You mentioned a stronger dollar recently in the last couple days. And across the Allies, whether you're looking at Polish zloty or Turkish lira, these are, I think foreign exchange tells a story about the challenge.
Have you seen the year-to-date gains in European equities? Should I go through them just briefly?
You've been following that.
In Paris, the CAC 40 up 13% year-to-date. The DAX, Frankfurt, Germany up 11% year-to-date. Spain up 12. Italy, the FTSE MIB up more than 15. European equity story is just running away. So we've got to frame what's taking place at the moment, Tom. A year of this war, which is just dreadful, deeply, deeply unsettling stuff. And on the other side, we're talking about a European economic recovery, an equity market that's off to the races, an ECB that's hiking interest rates, and the energy crisis of a number of months ago looking less like the crisis it could have been.
Most wars are like this. Not that you can predict what they're going to do, but the gloom gets there. And as Julian Emmanuel says, we bounced off the gloom of, it's now 60 days ago, maybe even 70, 80 days ago.
But as the gloom in the economy fades, Tom, does the support for this war in places like the United States and across many countries in Europe, does it start to fade?
Well, does it start to fade? And so much of that is focused on China. I thought Ed Hyman of Evercore ISI was just really something yesterday, folks, reaffirming their belief on China growth. Joining us now is someone expert on the granularity of China, away from the headlines. Leland Miller, to say he's Chief Executive Officer of China Beige Book International doesn't describe the ability. Leland, what is the symbolism you see if a year ago Mr. Putin's talking a football field away on a table to Mr. Lavrov versus what we observed, I believe it was yesterday, between Putin basically playing bridge with Mr. Wang of China? What is the symbolism of how close they were yesterday talking to each other?
Well, the imagery is perfect for this. I mean, you have China making no bones about being closer and closer to Russia, particularly as Russia's encountered way more problems than anyone expected at the beginning. So I think there's no question right now that from China is all in on Russia's side from the perspective of their support. The question is, are they crossing red lines in the background? And that has become, it wasn't an issue the first 6 months of the war. Now there are reports that they might be willing to cross lines in terms of providing goods to Russia, providing lethal arms. That takes us in an entirely different direction.
Is the backdrop here a recovery after pandemic for China? Evercore ISI suggests, as others do, we could see buoyant 5, even dare I say 6% GDP. Do you agree?
I do agree. Look, there will be a cyclical bounce back in China starting in the second quarter. I think people have made too much of baby indicators in January and February. Oh, the story should be more bullish or less bullish. The recovery will start no earlier than March, possibly April, and then you're going to see a real recovery because businesses will get back at it. They told us last year they didn't want to invest, they didn't want to borrow, they didn't want to hire. Well, now they're going to do some of that, and there will be some measure of revenge consumer spending as well. The question is, when you get to the second half of the year, how much policy support the government wants to lay on top of what will already be an organic recovery. So you absolutely have the ability. You're bouncing off terrible numbers for 2022. The numbers will be good. There will be a recovery in China in 2023. The question is this more than 2 to 4 quarters? We don't think so.
Leland, there's a lot of attention at the moment now on the auto market, given what's been happening with Tesla and other brands. Are you seeing the Chinese consumer turn more and more to domestic brands within China?
Well, it's sort of hard to read through the noise of COVID. I mean, in general, yes, I think that's the inclination. But you have a big problem where the world wasn't exporting much during a time where China's exporters were running full throttle for the last 3 years. So as we get into the post-COVID era, we'll be able to tell that more. But certainly, when you look at cars and you look at some developments in EV technology and battery technology, the Chinese are dominating. So there will be an inclination to buy home on some of these things. And maybe a lot of things.
We've been trying to sort of decipher the change in Xi Jinping's tone over the past year. You talked about how the red lines they didn't want to cross, they now seem more willing to cross. And what is the implication from the underlying economy? Is it youth unemployment going up? Is it this sense of frustration with the administration? Is there something going on that can give us a sense of why there's been this shift?
There has been a shift, but I think it's a mistake to call it the game changer that a lot of people on Wall Street are saying. There was never a desire by Xi Jinping to run the property sector from its heights in the pre-COVID down to zero. There was always going to be a little bit of a roller coaster ride. And the way that we described this was they need to cull the herd and then ventilate. Cull the herd to take out weak firms, but ventilate before they take out the strong firms, before cash flow dries up, before contagion spreads. So you're in a ventilation part of the sector. If they think the risky companies are still doing risky things that need to be handled, then we're going to go back into that part of the cycle. So this is a relatively gradual process to minimize property as a growth driver. The fact that we're seeing a relaxation of the 3 lines, that's happening right now, but that doesn't mean that Xi Jinping has suddenly decided his policy of the past 3 years is wrong. I don't think he has.
Although going forward, do you think that this is a sign that perhaps the Chinese economy has insulated itself enough from the U.S., from other nations, that they can withstand sanctions or any consequences put on the nation as a response to crossing other red lines, say, with Russia?
Depends on the sanctions. So I would say that, the sanctions that we were used to, 3, 5, 10 years ago, sure, they're baby sanctions, sanctions on individuals, baby sanctions on banks. The kinds of sanctions we're looking at right now are big economic warfare tools. Foreign direct product rule can take out the Chinese tech sector, could take out major Chinese companies. This is the question about whether China will actually move forward with violating the big bang sanctions, giving Russia tools in Ukraine, giving Russia arms in Ukraine. If they do that, then President Biden's going to have a very big mess on his hands, because in order not to hollow out the credibility of these really powerful sanctions, which were intended for China in the first place, if you really look at it, then he has to follow through and crack down on companies that are violating. But that could cause a bigger brouhaha with China this year, which is something he's been trying to avoid. So if the Chinese are behaving badly right now, and we don't know yet, but there are leaks that they are, then this could go in a very negative direction this year.
And quickly. This is a very tense moment. Leland, thank you, sir. Leland Miller there of the China Beige Book International. The outlook for growth for GDP in China, still pretty decent. I'm going through the ECFC screen on the Bloomberg terminal, just captures growth projections. The median projection, Tom, for Chinese GDP, 5.2% this year, 5% the year after, 5% the year after that. People just saying five handle.
Bloomberg's got a great study of this, and this looks at annual GDP, and there was that time of the fiction of 10% GDP, 2010, 13 years ago. 10% GDP, down we go to the shock of the pandemic and 2.2. I did a fancy moving average study, and this is out 9 months or so. It's a 5.8, 5.9%. I'm going to call it center tendency. And so that 5% is just below that.
Apple, in the middle of all of this, Anurag Rana just sent out a press release from Bloomberg Intelligence. It's a survey of Gen Z on Apple and brand Apple and the iOS system. Apple was the clear winner in Bloomberg Intelligence's most recent US smartphone survey of those Gen Z consumers aged 18 to 24, 79% preferring it versus a current market share of 41%, leading us to believe, us being Bloomberg Intelligence, that iOS can become more dominant as these users age. That's the take from Anurag Rana and the survey they've done, Tom.
The sell side looks at what they call the addressable audience. And with a cloud, this is a huge, huge topic. But with Apple, it's not that they're gaming it out as Anurag is doing there. They're just looking at the statistics from last quarter, which is the usage of all that stuff that I get all these little bills on my charge card of stuff that Offspring are doing on Apple.
iTunes bills.
Accountable numbers.
Yeah, I know.
Yeah, you don't need ChatGPT for this.
No, it's really irritating. I get messages occasionally. I'm like, really?
Yeah, really, $3.99.
Do they like the iOS system, though, or do they just like the brand?
They like the interface. I don't think that it's about the system. They like the way it looks, the art of it.
So not just like the brand, I've got an iPhone.
No.
That doesn't move the dial.
It's not that. Nope. It's not a visual thing.
Is that just our age group that's just like the brand, Apple?
Yeah, they're not
People just seem to be drawn to it.
Yeah.
Okay. This was good. Thanks.
DPDHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly with just a couple people. Our average restaurant now does about over $1 million per restaurant in digital sales.
Fed has one mission, right? They want to raise cash rates high enough so that you buy a 6-month bill and not the high yield market.
The Fed clearly is also being very, very data dependent.
We still have a high inflation environment. It's something they definitely have to get under control. And we're still just not there yet.
We should be in a recession right now, and it's just not happening.
We're already getting into an environment where life goes on.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Good morning on radio, on television, on ChatGPT. We are here. And, John, when you've got Ed Yardeni and Ed Hyman back-to-back, as we had yesterday, they're saying life goes on.
It's on to claims. 30 minutes away. Jobless claims in America are expected to come in and around 200,000. Tom, throw that in with the rest of the pot. With the economic data so far year to date, it's been pretty resilient compared to what people thought would come.
We have 48 hours of a lot of data squeezed in here in a 4-day work week, and it's just going to be amazing to see. And we've got to go to what Chairman Powell's looking at, which is one measure of inflation, PCE deflator, 5%, and that buttresses against EU inflation out this morning, which actually went up a little bit.
Eurozone CPI, core, all-time high. More work to do. They're going to go another 50 potentially.
Well
the ECB.
Well
Thank you. The Federal Reserve, they're communicating. They've got more work to do. I just sort of scratched my head a little bit about what Chairman Powell communicated in the last news conference because much of that wasn't really captured in the minutes yesterday, Tom, but I guess we'll move on.
We'll move on from the minutes because I didn't read them, but what I am going to do is move on to what we see in the interest rate market, and you can pick your weapon here. To me, I just looked at the 30-year mortgage, and, we go through 7%, Lisa. We're not there yet. 7.2% was maybe the angst. Is anyone modeling in the probability that the mortgage goes through to a new high level or that the 10-year goes through to a new high? I don't think people have factored that in yet.
A lot of the guests that we've been talking to really talk about the potential to buy duration, to basically expect yields to go lower.
Because they get the gift of a coupon.
This is the belief, the ultimate faith in the Fed. And you see this in markets right now. People believe that the Fed will be able to get inflation back down near 2%. This is what's pushing financial conditions to perhaps not be as tight as they otherwise would be. So here is the question. Is the market right? Or has there been some sort of more substantial change that we're seeing in the data that's going to make inflation stay high for a bit longer?
I mean, we're going to get to claims here, and it's the arch question that I think Chairman Powell wants to know. Is it a fully employed America? And then critically, he doesn't want it to be a fully employed America. There's some people pushing back.
Except they don't say that, do they?
No, they don't say it, but that's what they're thinking.
We need to, see demand soften.
Yeah.
Yeah.
More loosening, et cetera.
We use all these different phrases. And then when you ask them about it, they're just like, no, that's not what we want to do. What we want to do is get inflation down.
Right, because that's important for the stability and the health of the economy.
Let me jump to the data here right now, John. I'm going to go to the Bloomberg Financial Conditions Index, which is more restrictive than the nirvana of 10 days ago, from a 0.4x% down to 0.24. Still accommodative, but we've just given it back. And again, what's that probability that these series indicate higher yield?
For yields as well. So maybe that correlation will ultimately break down at some point. Of 3 basis points on a 10-year, 395. There it is, Tom. You've been waiting for that.
There it is. I mean, this is
and
a
getting
grind.
closer to 4.
So now, John, this is important. This is a word we haven't used, but I'm sorry, 3.9508 is grind towards a higher yield. That are we going to adapt and adjust this? I'm not prepared.
Hey, you
for
might
it.
be one strong data point away from 4, Tom, on a US 10-year. We're through 470 this morning on a 2-year. Yields up there about a basis point.
Let's dive into this right now, folks, and it has to do with the equity market, your 201k, your long-term view, and maybe even the speculation of the short-term view. We do this with Sam Stovall, Chief Investment Strategist, CFRA. Sam, we've been busting chops all morning about equity guys analyzing the bond market. With great respect for your work, how does an equity guy like you use the bond market as a study?
Well, Tom, certainly, the question is, with higher interest rates, what kind of an effect that's going to have on the discount rate used within intrinsic value models. Also looking at substitution capabilities, where if investors say, you know what, if I'm not going to really get that kind of return in equities, do I want to start nibbling at the fixed income market? Because expectations are that a year from now, we could end up seeing very nice gains in fixed income. So investors are constantly looking, in a sense, jumping from one lily pad to the next, looking for the best opportunity down the road. And that's why they look at both sides of the equation.
Sam, it's super difficult to generalize because the answer to the following question will depend on the individual circumstances of the investor. But Sam, when people call you up and they look at the yield curve and there's kinks all the way through it, you've got 5% on a 6-month, 470 on a 2-year, on a 7-year, through 4% on a 10-year, just short of that. What are you advocating for? What do you talk to them about? Where do you tell them they should go?
Well, I tell them that history would tell them that we are due for a recession, that whether you look to the year-on-year percent change in CPI or PCE, at these levels, we have fallen into recession with a bear market. Looking to year-on-year leading economic indicators, ditto to a bear market environment. The yield curve is as inverted as it's been since the early 1980s. And then also looking at S&P 500 earnings, typically operating results tend to be coincident with a recession. And right now we're beginning to slip into an earnings recession that probably last until the summer of this year. So I would tell investors that when investors finally do start to look across the valley, the turn will be very, very quick. The S&P has gained an average of 13% in the 9 months after the Fed has paused its interest rate policy, because it typically starts to cut interest rates 9 months after. And when you see the market up by double digits, you see all sizes, styles, and sectors in positive territory. I think you don't want to be wrong for too long and therefore on the sidelines for too long a period of time.
Looking across the valley, I think a lot of people are looking across the valley. I think that a lot of people are crossing that valley, which is the reason why the valley hasn't happened. I mean, basically, people are getting ahead of the downturn, and I'm wondering at what point you're going to end up.
Can you do all that again? Because I'm lost.
Basically, listen, no, seriously.
In the control room, will you bronze this, please?
Sam, help me here.
Start again. No, just for me, so I can catch up.
Valley high.
Look, it's saying, if you look, Sam, you were following what I was saying, that basically people are not on the sidelines because exactly what you're saying. They don't want to miss out on a rally that really stems from the beginning stages of a recovery. How do you know when you're getting there?
Well, that's a very good analogy, despite your cohorts laughing at you. Because basically we don't know how long the valley is and whether it's a mirage that we're actually staring at this point. So I think that's the concern, and that's why the volatility has been picking up. That's why investors are now questioning whether the October 12th low at around 3,500 will hold. I think certainly we have to retest that level to decide if the October 12th low is the low for this market, or as some technicians are saying, no, we've got to drop down to a further Fibonacci retracement level around 3,200 on the S&P. So I think right now the question is, how can you as an investor, in a sense, rein in your emotions so that they don't become your portfolio's worst enemy?
So we're talking about reining in emotions. I wanted the emotion of big tech. We talked about how they were a dog if interest rates were going up, and now people are saying that they have the ability to cut much more than others. Where do you stand on that? Will that still be a leadership as you look to indexing?
Well, interesting, but technology is the only sector that's in positive territory month to date. So giving up, if you will, the positive performance for the market in January, positive signal for the January barometer. February historically is a retracement month, the second worst month of the year, second only to September. But technology does have the growth potential, does have the profit margins, and I think it has investors' attention because they want to gravitate back toward the growth area. Typically, following a down year, investors rotate from first to worst, meaning going from the defensive consumer staples, healthcare, utilities, into those groups that were beaten up the most, and tech was one of them.
Hey, Sam, thanks for this. As always, Sam Stovall there of CFRA, alongside Lisa Bravitz, and the valley this and through the valley and on the other side.
You have to look across
down
the
into
valley.
the valley and across it.
So that you don't miss it.
This is David Gurrow saying this to me a couple of days ago. Down
on the banjo?
valley. No, David did it on the fiddle. Down
the fiddle.
and he's really quite good.
But that's the fiddle.
Yeah.
The fiddle's like a violin.
Yes.
That's good.
Yes.
You know,
That's the
grand
banjo.
old-
This is the
Down
This
in
is
the
great
valley.
radio. This is
Valley
fantastic.
so low.
No, keep going. I like that.
My
That's
father
great.
used to sing
All
this,
right, no,
you know.
just keep going.
Over a can of Jenny Cream Ale.
How many cans did you consume?
Well, it depended.
That's like a 10-year-old.
Down in the valley, valley so low,
Glad I-
Bramo is gloomy.
This works.
Hey,
Is that going in a promo
no.
as well? ChatGPT said no.
Okay.
That you're not.
Just so that you know, our fantastic listeners also had a message for you. Somebody was questioning whether you're actually Italian because there is evidently an entire industry, Pizza al Taglio, which is where you can buy it in.
Are you saying
pieces.
ChatGPT questioned that?
No. An actual live viewer wanted to write in and just say that. So just wanted to, you know.
I've been with John. Wait. I've been with John at Chelsea Market, and he walks in there with all the tourists, and they shake at the Italian places when he walks in. I mean, they just like stop, and you see people whispering to the manager, you know, about the pizza
I'm here to
quality.
collect. That's the part-time job. I'm just here to
That's
collect.
good. That's great.
That's it.
Okay.
Yeah. All right.
Okay.
Thanks for that.
That's great.
Futures. I'm not. That's not what I do. Futures on the S&P.
They're pretty good.
Just in case you thought maybe that's what I did. I'm not. Up a 0.5% on the S&P 500. Matt Lazzetti of Deutsche Bank is going to come up very shortly. Matt Lazzetti in the last couple of years has just been fantastic. He made this great move on calling a recession when other people really weren't calling for one. And Tom, what he did was pushed it out. He pushed it out. Agreed. Matt's going to be with us in New York, I think. That's cool, isn't it?
Yes. Yeah.
Very cool.
He's probably going to be from the Deutsche Bank
No,
Towers.
I think he's coming into the Bloomberg Tower. Right?
From the Deutsche Bank Towers, which I still don't call
The Deutsche Bank Center.
The Deutsche Bank Center. Yes.
Yeah.
Still getting it wrong.
We're still
Even as we try.
I spoke to someone about this recently. I was just like, Time Warner Center. They was like, it's
Warner
the Deutsche Bank
Brothers
Center.
Discovery
They didn't even know it was the Deutsche Bank
No,
Center.
nobody does. Well, maybe he can do better branding.
Lazzetti.
Let's see.
Okay.
Time out.
This is Bloomberg, apparently.
Yes, it is. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Core inflation in the Eurozone set a record last month. That probably cements the European Central Bank's plan to raise interest rates by another 0.5 percentage point in March. Core price gains reached 5.3% in January. Headline inflation, which includes food and power, was up to 8.6%. The minutes from the latest Fed policymakers meeting shows the central bank is inclined toward more interest rate hikes to curb inflation. Still, almost all officials back slowing the pace of increases. The market indicates that 25 basis point hikes are likely coming at the March, May, and June meetings. President Joe Biden says Vladimir Putin has made the world less safe by suspending participation in the new START nuclear treaty. Still, he told ABC News he doesn't believe that means Russia will use nuclear weapons. The treaty aims to limit the deployment of intercontinental range nuclear weapons. Shares of Alibaba are higher. Profit at China's e-commerce giant soared 69% last quarter. Alibaba kept a lid on costs, and shoppers continued to spend online while the pandemic raged. Still, revenue increased only 2.1%. Some investors worry that a sustained recovery in Chinese consumer spending may take some time. And Tesla is placing its global engineering headquarters in Palo Alto, California. CEO Elon Musk appeared alongside Governor Gavin Newsom at the announcement. It's a sign of renewed cooperation between the electric vehicle maker at the state that must scorn the last few years after moving its corporate headquarters from California to Texas in 2021. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Today, the global spotlight is on India as the G20 financial leaders gather. Among the issues on the table, debt relief, inflation, climate sustainability, and more. Live coverage continues on Bloomberg, your global business authority.
It's going to be pretty painful. And the no landing story, I think, is looking at things right now. And right now, the economy is doing great. The Fed, I think, is doing a pretty good job of communicating what their plans are. If I was them, I would pause and see what they've gotten done so far.
Ed Hyman of Evercore, ISI, the chairman. Always great to hear from him. Looking for a pause from the Federal Reserve. Not predicting one, but calling for one. Matt Lazzetti of Deutsche Bank walked into the studio just moments ago and he said, everybody calls it the Deutsche Bank Center. Not sure I believe him. Equities look like this on the S&P 500. Good to see you, Matt. Futures look like this, up 0.5%, advancing just a little bit. Yields higher, Tom, by, let's call it 3 basis points. Your 10-year, 394.30.
Yeah, let's get right to it. We have to do that with the important economic data coming up as well, and we're thrilled to bring you from our studios in New York on radio and television worldwide, Matthew Lazzetti, Chief U.S. Economist at Deutsche Bank. Matt, thank you so much for joining us in studio with this data coming out as well. You nailed the when of it. You absolutely nailed not only the vector of the call, and this on GDP and recession, and not NBER recession, but the idea of a slowdown. But you nailed where everybody got wrong, the immediacy of recession, and you said no. Do you stick with that now? When is the when of any kind of slowdown that we see?
Yeah, I think the recent data we've seen over the past several months, if anything, I think gives you greater confidence in that kind of timeline. Certainly the economy has momentum now. What we've seen from the jobs reports or retail sales or some of the survey data bottoming and picking back up all tells you, I think, that Q1 growth should be solid, certainly above trend, we think. I think that the ongoing narrative that we hear from the Fed about this kind of gradual slowdown in growth over the coming quarters doesn't really seem to fit with the data that we have. I think that narrative likely has to change. But at the same time, what we've seen from an inflation perspective is a lot less disinflation than we thought late last year. We see core inflation picking back up over the coming months. We think that leads the Fed to be more aggressive. We have a 5.6% terminal rate, which I think then builds into the hard landing risks later.
Well, let's talk about the hard landing risks. Where do you have the downturn on the calendar? Difficult to do, but just to set up the conversation, where do you have it?
No doubt, just difficult to do. We currently have it in Q4. We've gone Q3, Q4. It's always been a second half story for us. I think it's a few things. One, we do expect the Fed to be more aggressive. The market has repriced the terminal rate a lot, but I think not enough yet. I think we will probably see the market reprice it higher on upcoming inflation data. And then you have a number of things in the second half of the year. Households lose their excess savings. I think that leads to household fragility. You obviously have a debt ceiling, which could lead to financial condition tightening and weaker government spending. So there's a lot of risks as we look out into Q3.
You're at 560 now, right?
We are.
Terminal rate. Do you think there's upside risk to that view?
Look, with the data as it is today, I do think that there's upside risks to that view. If you look at the labor market, and I think it's really important, it's not just the latest data points, because we should take the January data with some grain of salt, given weather, seasonal adjustment factors. We had meaningful upward revisions to household income in the Q4 of last year. You've had inflation data, which was revised up meaningfully in Q4. So I think as you look at the Fed, I don't think that they will really have any evidence of disinflation by the May meeting. They'll may only have a month or two by the July meeting. And really, it's a question of, can they tighten financial conditions enough? I think we heard concerns about that in the minutes yesterday.
I want to dig into that a little bit more. Upside surprise to 5.6%. Is that because long and variable lags isn't a thing, and we're already seeing basically the effect of the tightness, and it just isn't tight enough at a 5% or a 5.5%, or is this a less interest rate sensitive economy that needs to have a much bigger shock?
Yeah, I think there's two lags that we probably want to talk about. There's what the Fed does and what happens with monetary policy to financial conditions. I think that lag has been very quick and tight. We saw it reflected in mortgage rates. Financial conditions actually tightened very quickly. And then there's the lag of that financial condition tightening onto the economy. I think that's where we are probably seeing an economy that's more resilient. You have the excess savings. We still think it's $1 trillion. You've had state and local governments that were sending out checks. So there's been this latent stimulus in the system. At the same time, you have a labor market that's undersupplied, which I think is making it very resilient to the tightening so far. So I think those two lags have different lag structures, but the one where it hits the economy, that's taking longer than I think what we've seen in the past.
Is there a sense that there is a level at which the economy would break, or that could really put a major halt on an economic trajectory that still seems to have momentum?
Look, I'll be quite honest. I think we don't know what level that is. And I think that's in part the idea that there's upside risk to the terminal rate. Going back a year ago, if you would have said that we'd have a 5% handle on the Fed funds rate, and we'd be contemplating whether or not the economy would be in a recession, I think that'd be almost preposterous conversation to be having. As we continue to price higher, financial conditions, they're tight. They've tightened, but I don't think they're tight enough to achieve the Fed's dual mandate objectives. And so I think we have to be open-minded and humble about where that terminal rate is actually going to be.
I want to take the heritage of Deutsche Bank, and this goes back to 13 years now, to a raging debate at the time off of Dooley, Garber, and Folkerts Landau, David leading all of your research effort. And there was a titanic debate about China savings and China flow. Paul McCauley was involved in this, and Brad Setzer and others. I want to bring that to the domestic right now. Not the unknown with China, but what's the unknown for Matt Lazzetti in the American economic experiment right now? What's the mystery out there for you 3, 4, 5 years out?
So I think 3, 4, 5 years out, there's this really interesting conversation about what the neutral Fed funds rate is likely to be. It does play into a little bit about the global savings story. And I think it's really about what are we seeing today that is simply reflecting unique circumstances around the pandemic, or what is it something that is more structural? I think some things that we know that might be more structural, I think inflation is going to be structurally higher going forward. We have all these shifts going on, demographic forces, deglobalization, you have climate change policy, all these things I think are at the margin at least are going to be inflationary. I think you also have a world where maybe fiscal policy in the U.S. has not structurally changed in an easier direction, but I think globally we might see that shifting in a more easier direction. And I think that does lift the neutral rate for the Fed as we look ahead.
He's Rogoffian.
You see that coming from Europe, China? Where do you see that coming from?
So I think we have, in Europe, we have defense spending, you have climate change policy. In China, you likely have a shift away from domestic savings in their economy over time. In the U.S., it's a more open question. We have a debt ceiling debate that's going to be happening in the second half of this year. Could this lead to fiscal retrenchment? It seems pretty likely that it does.
He put that sentence in there on China savings just to keep his job. Folkerts Landau's watching.
Are you getting questions on that debt ceiling debate yet? Or are people avoiding it? Is it you trying to talk to clients about it, or clients trying to talk to you?
It's clients trying to talk to us at the moment. I would say that the past few, it was more, we have to come up against it, you have to see it reflected in the bill market, and then everybody starts to focus on it. I think this time around there's been a lot more focus early on. Maybe it's what was going on with the speaker leadership votes. It's very clear that I think from both sides that they're kind of entrenched in their views at this point, and that it will be an issue. And so I think that there has been greater focus on it this time around.
You think for it not to be an issue, it needs to become an issue. And what I mean by that, they need to push it far enough that something happens in markets for them to back away. Is that where you see this going?
Yeah, I don't see any way that either side should back down from their view unless it becomes an issue where financial conditions begin to tighten.
We've all got it's an issue for like somewhere else further out in the Canada, Lisa, like in the summer, deep into the summer.
It's such a frustrating discussion to have.
Massively.
I mean, there's a group of economists over at Jefferies put out this note basically saying some of the sell-off that you've seen in bills with yields rising above 5% in the short end could be tied to some of this debt ceiling debate. Mohamed El-Erian came out and he basically was like, no, it's not, it's all the Fed. But, this is the issue. It's sort of like, how do you game that out? Because even the reaction function in markets, what is it? Is it to go into short-term debt because it's safe? I mean, the irony around how the market would even respond when it does become an issue.
That seems to be the play every single time. We'll see if it's different this time.
It's frustrating, but people are concerned about the more significant economic ramification of spending really declining, and that has some serious implications.
In about 5 minutes' time, we'll get jobless claims. Jobless claims are expected to come in at 200K. I want to pick up on something Matt Lazzetti said, and Matt's going to stick with us, I'm pleased to say. Matt talked about 5%, and if you told us we were going to hit a 5 handle on Fed funds 12 months ago, 18 months ago, and then you were asked to guess, okay, let's assume we get there, where are claims? I don't think you'd turn around and say claims would be in and around 200,000. I don't think you'd have unemployment at 3.4%. I don't think you'd have retail sales month on month growing at 3%. I don't think you'd have any of that stuff in mind, Tom, and that's where we are.
I go to the resiliency of the American economy. I sound like a broken record, but everybody adapts and adjusts. And what we're adapting and adjust to is the 13-year, 14-year free lunch we've had on rates. It's over. And are we going back? No, but we're going on to something that is elements of what we used to know.
Can it end and truly avoid a major break somewhere? I think we're all still
Can it be
looking out for that.
Down in the valley?
Down in the valleys somewhere. Do you want to sing us out? You've got
No,
10
I don't
seconds. Don't fancy
Lazzetti will walk out.
You had complaints.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Love this line from Governor Kuroda. He says, the G7 needs to keep on tightening to cool inflation, but Japan needs to keep up monetary easing for stable inflation. That's the BOJ view. He's got one more beating left, Tom.
Did he mention Matt Lazzetti in his comments?
He didn't mention that. I think you might have missed that one, Tom. Matt Lazzetti alongside us from Deutsche Bank. The economic data in the United States about to drop across the Bloomberg terminal. There it is. Here's Mike McKee. Morning, Mike.
Morning, John. We're getting just the preliminary numbers coming in, and we're surprised again. 192,000 jobless claims. That's a little bit weird given the situation. It was forecast to come in 200,000. You mentioned that before the break. Last week was 194,000. I'm waiting to see what the revisions are for that. GDP has been revised, as it always is. This is the second revision. 2.9% was the forecast, and that was the original release. Now it drops to 2.7 as we lose some personal consumption, down 1.4%. Apparently, Americans spent less than we thought they did in the first quarter. 2.1% was the original release there. We do get the quarterly PCE price index, which is up 4.3%, and that's up from the initial release of 3.9, which does not serve us well for tomorrow. Initial claims have not, I don't have the update in terms of, oh, here we go. It was only raised 1,000. So we are in a situation with jobless claims where we're at 192,000 for last week. The week before, 195,000. The forecast was for 200,000, and nobody's filing for jobless claims at this point. The continuing claims number, 1,654,000, is down from 1,691,000. So the labor market remains strong. The Fed noted that yesterday, and it does look like inflation may have picked up a little bit more in the fourth quarter than we had thought.
Mike McKee, thank you. That number, 192,000 on jobless claims. We did mention a little bit earlier this morning, we might be one strong data point away from a 4 handle on a 10-year. Yields up 5 basis points on a 10-year, 3.96. Can round it up if you like. We're very close to 3.97 on a 2-year. 4.72. Yields are higher by a couple of basis points there on a 2-year as well, very close to 4.72. Closing high of the year was about that level, so we're back there right now. So yields up. Equities pulled back just a little bit on the S&P 500, still advancing though by 1/3%, just off session highs. On the Nasdaq, still up by about 0.8%. You can thank Nvidia for all of that, or Nvidia, whatever you want to call it. Anyway, core PCE, a little bit hotter for the fourth quarter, Tom. That's another read of that, 4.3%. Jobless claims expected to climb higher. They did not. They declined to 192 from a revised 195. What do you make of that?
GDP price index up as well. And just the amateur take I take is to add up GDP annualized plus the GDP price index, and I got nominal GDP of 6.6%, if my Matt Lazzetti math is correct. And I'm sorry, John, that's what keeps you going when you've got nominal GDP at that level.
Matt, we've got to come to you on that. Yeah. Matt Lazzetti from Deutsche Bank alongside us. Can we just start with that number, 192,000? Your thoughts on it?
I mean, it's remarkable. I mean, it's remarkable that the Fed has tightened as much as they have, and you don't see a labor market that is really certainly not shedding labor. It's not coming into better balance as the Fed had hoped for. I think the revisions to the recent data you've had, plus the latest data, show really no weakening at all. I would highlight the core PCE number there as well. Upward revisions, I think it likely reflects the seasonal adjustment that we saw in the CPI, now getting reflected in the core PCE data as well. You get that at plus a 0.5 reading tomorrow. I think the Fed minutes, the sentence that I focused on the most was, there's concern if they don't tighten sufficiently that progress on inflation could halt. I think that with the revisions to the data, with the incoming data that we're seeing, there has to be a question about whether or not they are tightened sufficiently and whether or not what the market is pricing right now is tightening sufficiently.
After payrolls, I spoke to a lot of people that said there was more noise than signal in the January data. Based on the data we've had in the last couple of weeks, do you think there was more signal than noise?
Look, I don't think we're going to print 500,000 jobs per month on average.
Of course.
So there's no doubt.
Make a headline out of that.
There's no doubt a lot of noise there. But when you look at the broad labor market data, if you look at the JOLTS data, a few days before that, job openings picking up, initial jobless claims, everything is telling you a labor market that has momentum and that is tight.
I look at just the core equation, y equals c plus I plus g plus nx. Can we guesstimate any of those factors given we're coming out of a pandemic with a Biden stimulus? I am so fortunate I'm not doing what Peter Hooper's told you to do, which is actually try to guesstimate this. What's your confidence in guesstimating forward?
Look, it's always difficult, I think. It's even more difficult in the current environment. As I look at those Q4 GDP numbers, the downgraded consumption is meaningful. We were actually close to zero growth in private domestic demand already, meaning if you were to look at housing, consumption, and CapEx. And so it does look like from those numbers you had even probably a sharper slowdown in domestic demand growth in Q4. But I think the data that we've had since then is suggestive that that was a temporary blip. It was around the period where we think financial conditions were hitting the economy probably most significantly. And if the Fed does not continue to engineer conditions that are tight enough, you have an economy that I think is likely to pick back up and a labor market that is unlikely to loosen.
Does that mean that there's another 50 basis point on the table?
I think it's not the optimal choice from their perspective. If they ratchet up to 50 basis points, we get back into this process of how do you get back down from 50 to 25? And if you only want to go 1 or 2, it's going to be very difficult to do that by the May or June meetings. I think for the March meeting, if they need to deliver a hawkish surprise, you always kind of have that free card of the dot plot. The dot plot is able to signal their intentions. They could show a Fed funds terminal rate that's higher than what the market has priced in, holding it for longer. And the messaging, I think, is really important here. If they were simply to talk down financial conditions, as the minutes did a little bit, I think that would have an impact.
This is critical. This is original. Since when does a central bank, quote unquote, talk down financial conditions? I actually looked at that in the minutes.
Literally for the past decade.
Well, before they were talking them up. Now they're talking them down.
Right. Meltzer didn't talk about it. Anna Schwartz didn't talk about it. The Georgia School didn't talk about it. UCLA didn't talk about it. How do they, quote unquote, talk down financial conditions?
Look, I think we're in a obviously the past decade and a half is a new period of communications from central banks. It is guiding toward their expectations of what they want to do in order to bring about financial conditions that will achieve their objectives. And so they always should be asking the question, is the market interpreting our signals as we want them to be interpreting them? And are we achieving financial conditions that will achieve our
It's like
our
Dr. Phil, except it's Dr. Matt.
But the interesting thing is that actually this Fed has less power than it has for a long time, simply because the data is what the data is, and they have to respond accordingly. And the market is trading off the data. It's not necessarily trading off the rhetoric that we're hearing from the Federal Reserve. So, Matt, when you take a look at what we're seeing, especially at the upside revision to the core PCE, is there a sense that we could end the year with even a 4 handle on inflation or a 5 handle on the overall headline, something significantly above where people are projecting?
Look, you don't have too much confidence in inflation. It's been very difficult to forecast. I think it's just unlikely given that what we know what's going to happen with rent and OER. We know that in the back half of this year, those two really important components are going to be trending down. That said, we have a 3.3 core PCE forecast for the end of the year. The Fed's forecast of 3.5, which was laughed at I think a few months ago, looks a lot more plausible given the data that we're seeing. And you're in an environment where you don't want to discount upside risks to inflation, particularly if the labor market is not going to be loosening.
Matt, communication from the Fed over the last 10 years changed, and we've talked about that. They started to manage financial conditions in a much more direct, transparent way. But that's arguably because the nature of the economy changed over the last several decades. It became much more financialized. Because of the financialization of the economy, we also thought that when they started to raise interest rates, to your point earlier on, that it would hit the economy much faster. The communications changed, the nature of transmission has changed into financial markets, everything tightens up. I just think I have to sit here now and say there's so much we don't know. Because to your point, if you told me 12 months ago, told anyone, 5-handle Fed funds, guess where unemployment is, they would not have said 3.4%. They wouldn't have said claims at 200,000. So do you think we need to be a little bit more, and not you, because we get along, this is not directed at you, do you think we need to be a little bit more humble about what we don't know about what's happening with the Fed here? And do you think they need to be as well?
Absolutely. I mean, we're in an environment of significant uncertainty about the outlook, of a lot of data volatility, of mixed signals from the typically very reliable leading indicators that we would look at. You have an unprecedented environment in where you have households which are still sitting on a substantial amount of excess savings, where a labor market seems to be structurally undersupplied. You know, how all those things work out and how the lag structure of monetary policy to the economy works out is all key sources of uncertainty. I think for the Fed, my view is that it means they need to see evidence that things are moving in the right direction to be able to back off. We just don't have that evidence at the moment.
Is there anything stimulative about being able to earn money from your cash?
Look, if you looked at it just within that margin, I think you would say yes. The bigger picture is, as the Fed tightens monetary policy, we've seen what happens to mortgage rates. We've seen what's happened to the housing market. We see, rising delinquencies on autos. So I don't think raising rates is stimulative. I think that component of it could be, but the bigger picture is certainly that it tightens financial conditions.
That's straight out the school of Drew Mattis. Did he message you?
No.
Because that is exactly the kind of thing that Drew Mattis talks about.
But you have to think, if suddenly you can make 5% on your cash, then
you.
it's, free money. You can play with it. You can do things, et cetera. And then is there something stimulative, especially if you're not seeing the weakness, if you've got locked in mortgage rates, if you've got a lot of these other costs that have already been immunized? I'm just wondering. I'm throwing
the reverse argument was an argument people made when we had negative interest rates.
Exactly.
Yeah.
But that's what I'm saying.
That it wasn't spurring economic activity. Maybe it was spurring some people to double down and try and save more.
Exactly. So why couldn't you make the argument potentially that it could have the opposite effect? I don't know. It's just something to throw out there.
Something to talk about, something to think about, because I just don't think we've got a clue.
I think that's correct.
Any of this. I wonder if the Federal Reserve's even got the tools to bring inflation down towards target without just absolutely smashing this economy to pieces, which is what Mohammed's talking about.
I think that a lot of people are wondering what it looks like when you cross the
You
valley.
mentioned 3% inflation, Matt Lazzetti. Tomorrow, PCE deflator, top line 0.4, 0.1, 0.1. I do a quick 3-month annualized to get a 2.40%. That's how you get. What's the value right now of a 3-month annualized review by guys like you when you're wedded and the chairman's wedded to month, year over year? Is there value to looking at 90 days annualized?
Absolutely. I think, we know a lot of the year over year is being inflated by very strong prints that we had last year. You want to be looking at the shorter term trends to see to see what they're showing. And that's where I really think the revisions were important. So at the February meeting, the Fed thought core CPI was 3.1% annualized. They found out it was actually 4.2, 4.3% annualized, and you're getting a pickup in inflation on top of that. And so I think you've completely changed the trajectory of what it looked like at the end of last year.
That's such a strong point, Matt. Thanks for that. Matt Lazzetti at Deutsche Bank. I don't usually stay this long. I usually leave 10 minutes early. I stayed for Matt.
Your people, your people.
That's why I stayed. I stayed for Matt.
He really did.
That's true. Now everyone who's usually in this block and I'm not around is going to feel very offended.
No, that's not it.
That's not what. Anyway, Troy Gayeski's coming up in the next hour of FS Investments. Sarah Hunt of Alpine Woods, Jonathan Goll of Credit Suisse, all coming up very shortly.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. U.S. Treasury Secretary Janet Yellen says the global economy is in a better place today than many predicted months ago. In a press conference at the G20 Finance Ministers meeting in Bangalore, India, Yellen pointed to a resilient U.S. economy and moderating inflation. She also reiterated her calls for support to Ukraine as the one-year anniversary of Russia's invasion approaches. The Biden administration will take a security-first focus when it begins doling out $39 billion in funding to jumpstart U.S. production of microchips. Commerce Secretary Gina Raimondo says the objective is to return supply from Asia to the U.S. She says the plan isn't meant to subsidize struggling companies. A huge winter storm is battering the central U.S. on the way to New England. Record amounts of snow are falling, and by the time it's done, the Minneapolis area could get close to 1.5 feet. Now, hundreds of flights have been canceled. Meanwhile, the same system bringing record warmth to the southern U.S. J.P. Morgan collected more in overdraft revenue last year, despite changes designed to limit it. It's a sign that once more customers are having trouble keeping their accounts flush with cash. JP Morgan took in more than $1.2 billion in overdraft fees, a 3% increase from 2021. Bank of America's overdraft revenue fell 65%. And Wells Fargo is retreating from a business it once dominated. Bloomberg's learned the bank cut more than 500 employees in its mortgage unit this week. Wells Fargo also plans to shrink the portfolio of loans it services. That adds to thousands of job losses across the home lending industry. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far. But if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
There's a real tale of two cities, the best of the best and the worst of the worst. The best of the best today is really, really good. High quality space is very sought after by companies because they want to bring their people back and have new, engaging space.
Lean forward. Bruce Flatt of Brookfield Asset Management saying what we've been talking about through the morning, which is Class A is not Class B, C in commercial real estate. As I told you, Lisa, I've been really watching this. Thank you to Cranes, who's, I think, done a great job along with Bloomberg at Real Estate, Natalie Scamecci on this, that Manhattan landlords will owe in the coming months, that's the phrase they use, $12.7 billion in a redo. And this is the focus now of people like Brookfield with all of their abilities saying, this is how we gotta be, and you wonder what everybody else is gonna do.
And the backdrop is that people are using less office space as a result of hybrid working and the work from home space, and a lot of these leases are long leases for different businesses that come up in a couple of years, 10-year leases, 20-year leases. So when you start to reset, then you start to see the pain that we might not already have seen in the B and the C, but not the A, because there still is a lack of that relative to demand.
Those of you on radio and television, we do understand this is across the nation. It's not just about the island of Manhattan. We'll monitor this with our great Bloomberg real estate team, John Gittleson leading some of our coverage there. Right now, we continue on the festivities. The future's up 15. The VIX from a 23 level comes in nicely, 21.93, certainly a better tape than what we saw yesterday afternoon. I should note oil, we barely talked about it today, under $75. West Texas Intermediate, I'll get that out. Brent crude 81.30 as well. But all the focus is on the bond market, and that is the province of Ira Jersey, chief U.S. interest rate strategist at Bloomberg Intelligence. Ira, open question to your focus on short term, but let's take it out to the 30-year as well. Which part of the curve gives you the most information right now?
Yeah, so it has to be the short end of the curve because we're really hyper-focused on what the Federal Reserve is going to be doing. So it's not even the two-year note necessarily, but even shorter term than that. So it's things like, looking at where the December Fed funds futures and related overnight index swaps might be trading there. And we are still pricing for not only higher and more hikes, but also the Fed still to be cutting potentially by the end of the year. So even though now we're only cutting to where we thought we'd be at the end of the year before, you still have this up and down move that the market's still very very keen to continue to price.
Yeah, I'm looking, Ira, at the Ira Jersey function on the Bloomberg BTMM Go, and I've looked at it more in the last week, I think, than I have in the last 5 years. And Ira, I'm beginning to see a 5 handle across 1 year and 6 month T-bills. Help me with that. What is the significance of 5.00, or do you have a different level that's of significance?
Yeah, I think 5% is clearly an important number. We haven't been there in well over a decade when you think about how long it's been since the global financial crisis and the Federal Reserve first cut interest rates to 0. So 5% probably to some people are really happy. The issue with doing something like moving into very short-term paper, moving into money markets, is there's going to be a time to move out. And one of the reasons why I think you continue to see this very inverted yield curve is in part because even at, say, a 4% 10-year yield, or very close there too right now, you can lock that in for 10 years. And having 4% in 10 years when expectations are for inflation to be below 4%, maybe not this year or next year, but over the longer term, that seems very attractive given the last 15 years of financial history. I think the risk continues to be that that short-term interest rates go up even more, and that pushes us more toward a recession, which just is going to continue to see this crazy inversion of the yield curve that could probably last the rest of the year and maybe into 2024 if everything goes the way that Bloomberg Economics and I think things will develop in terms of monetary policy and the economy.
There's a lot there to unpack, and Ira, I'd love your sense to connect that to the data that we just got, which showed hotter than expected core PCE, at least the revised look at quarter over quarter, the fourth quarter in the United States. We also saw, again, another drop in jobless claims. Tying this together, how long do you think that the Fed could feasibly hold rates well above 5%, given that persistence in an economy that a lot of people cannot understand?
Yeah, so my view is that we will continue to have inflation, 3-ish% by the end of the year on a year-on-year basis, still above the Fed's comfort level. And at the same time, if we don't have job losses, I think that means that the Fed can stay at the ultimate level where the Fed funds rate will peak. So whether that's 5.25 or 5.5 is still very debatable, and there's obviously going to be a lot of data that is going to come out the next couple of weeks. And once we see that, I think that the Fed can be very patient and actually keep rates at the peak much longer than they have during the average cycle. So the average cycle, they start cutting after 6 or 7 months, but it could be over a year before they actually start cutting. And I think that that's one of the reasons why you'll continue to see this deep inversion of the yield curve, at least for the next 12 months or so.
Ira, there's a heated debate about whether to care about the debt ceiling and whether that's really affecting it in the pricing that you're seeing in the debt market. A lot of people would argue not yet, since typically it takes until you see the whites of the eyes of crisis. But how much are you seeing some sort of potential for a different type of distortion than we've seen in the past?
Yeah, it's not so much different. I mean, it's not dissimilar what we're seeing right now to what happened in 2011 and 2013, where the debt instruments that would be affected by a short-term delay of payment, which is really what we're talking about here, are being affected already. So when you look at T-bills out to late August and early September, that's really the sweet spot right now. We're projecting out in that range, September 1st, plus or minus a couple of weeks, that is in the danger zone right now. So you are seeing those T-bills actually be cheap on the curve compared to where you might think that they would be otherwise. And I think people have wised up to the idea that if we have a delayed payment, you just don't want to get in front of it because there's operational headaches, and you just don't want to be in those instruments. And we're already seeing some of that pricing.
And now the surveillance dumb question of the day, brought to you by Lisa Bramwitz and Tom Keene. I'll take it today, Lisa. Ira, if yields move higher in short-term paper, Who takes the loss?
So it's interesting you say that, because right now, with interest rates at 4.5% in the 2-year yield, you'd actually need the interest rates to go up towards 6% in order for you to start losing money in a 2-year note. So you don't actually take a loss; you just make less of a gain, just because of where the carry is. So
he sounds like an equity guy.
Well, but it's true, because you think about it, right? If the price of your bond goes down by 2%, and you make 4% in the year or more, you're still up 2%. So your actual break even winds up being several hundred basis points, which is very attractive in the short end, and one of the reasons why you're going to get these fits and starts, I think, in terms of how high front end yields can go.
Yeah, Lisa, years ago, young Jersey, I think it was at Credit Suisse, I can't remember, but he'd be in the mailroom, and the mail would come in for Neil Sauce, and he'd get the scissors out and start clipping the coupons. I mean, what you just heard there is textbook bond guy. I've got a coupon, and the coupon will salvage my loss as I take a lesser total return. Dan Fuss is up in Boston right now screaming.
Well, but to this degree, I mean, looking at the 5%, you can see that that's actually the greatest yield that you're getting on 12-month T-bills relative to the S&P 500 earnings yield going back as far as I can do it. I'm going to keep going back to the data, but honestly, this is a relative value proposition that, sure, even if you get some, price losses, that income offsets in a way that you really aren't even seeing in equities right now.
Out of time. Great briefing by Ira Jersey, head of Bloomberg Intelligence. He'll publish, you'll see that on the terminal today on all going on in bonds. I had the banner ready, Lisa. I did not send it to our crack team in the control room. 10-year yield, 4.00%. We didn't get there, but we did get to 3.97% on the shock of the data.
It just keeps surprising to the upside. And, the Chicago Fed National Activity Index, it's a peripheral one, but these regional Fed index data points are coming in also hotter than expected. It was supposed to be a contraction, a marginal one. It came in as expansion. Again, all of these pointing to the same thing. Well, and you talk about the trend line, great, these are not Fed index data points are coming in also hotter than expected. It was supposed to be a contraction, a marginal one. It came in as expansion. Again, all of these pointing to the same thing. Well, and you talk about the trend line, great, these are not necessarily significant in and of themselves. You put it together, it suddenly starts telling a very different picture.
Yeah, and I'm going to look here quickly at the 4-week moving average updated. The 4-week moving average on jobless claims is 191,000, and we'll get a new number here. Today. I've never framed that in my mind. I've never imagined that is where we are.
And is this because people aren't getting hired, they're not getting fired?
That'll be a topic for tomorrow. We'll do that with the economic data tomorrow. Stay with us on Bloomberg Television and Bloomberg Radio. Good morning.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. In essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, equity futures trying to bounce here from a 4-day losing streak on the S&P 500. Futures down 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the U.S. labor market is looking even more resilient. Secretary Yellen says the global outlook is improving, and nobody at the Federal Reserve wants to stop hiking. We begin with the big issue, looking to bounce back from the longest losing streak of 23.
Stocks had a big move up to the start of the year. They've given some of that back.
We're in this sort of uncertain environment.
There are risks.
Recession risks.
Recession risks. Recession talks.
The geopolitics at the moment still looks pretty difficult.
Geopolitical risk. That geopolitical risk is higher now than it has been for many, many years.
We still have a high inflation environment.
Inflation remaining stubbornly higher than what the Fed wants.
Stocks have got ahead of themselves.
The downside risk is higher than the upside risk.
It's going to be pretty painful.
The inklings of some of a broader slowdown is something to pay attention to.
Something to talk about right now. Alpine's Sarah Hunt and Troy Gayeski of FS Investments with us this morning. Great to have you both with us. And Sarah, I want to start with you. The last time you and I spoke, you said there was upside risk to this equity market. That could be the pain trade. Is that still the case?
I think that was a little bit earlier in January. So I'm going to say I think that we've already had that upside in that pain trade. And I think what you're seeing now is reality coming up against the fact that the data is in fact getting a little bit more supportive of a stronger Fed, and the equity markets, that's going to be tough for them. And they've already had a fairly large move. I mean, the NASDAQ is still up 9% or over 9%, close to 10% year to date. And the S&P is up close to 4 or 5. So I'm not sure that we're seeing a pain trade higher now. I think we're going to see a lot of uncertainty and a lot of swings around big data points.
Adding some more weight to that move this morning, that's for sure. Up 0.5% on the S&P, up about 1% on the NASDAQ. Keith Lerner of Truist was on the program earlier this week. He said bad news was bad news, good news was bad news. Troy, do you agree with that?
Yeah, I think when you get markets priced to perfection, we had another very strong bear market rally, driven first by short covering, and then, of course, gamma trading, and then CTAs and trend followers flipping bearish positions to at least neutral. And then eventually you suck in people to the more perma-bullish argument. And then you got equities back up to 18.2 times forward earnings. And then, wouldn't you know it, John, yet again, the economy stays incredibly resilient, led by the labor market. The talk of the Fed hiking more aggressively comes back, even doing more balance sheet drainage. And 18.2 times forward earnings is not cheap unless you're referring to the era of QE asset inflation, and those days are over.
Those days are over. Based on the Fed minutes yesterday, I'm not sure what we learned. Sarah, I went through them. Chairman Powell said in the news conference 11 times, according to Mohamed El-Arian, the word disinflation. And then we all opened up the PDF and tried to find the word disinflation and couldn't find it. Sarah, what's that about?
That's an interesting question to which I really do not know the answer. I read those minutes too and felt the same way. They also didn't talk about pausing, except as somebody mentioned yesterday on Bloomberg, that it was a pause outside of the U.S. I think that there is a real question here about what's going on with the data and whether or not some of the strong readings in January were seasonal and whether some of the weaker readings in December and November were really what's going on. And I think that that's just going to keep happening data point by data point. And as you saw this morning, you saw stronger numbers on the inflation side, and the labor market is still very strong. Now, the Fed has hiked very quickly, relatively speaking, to history. So we're not sure when those, long and variable lags actually come in here. But if we don't have some sort of a reaction, I think the Fed is going to keep raising rates given the backdrop and the data that we're seeing right now.
Claims this morning, 192. We were looking for 200K. We dropped from 195. Core PCE, quarter on quarter, 4.3%. We were looking for 3.9%. Now, Troy, in January, we had some fantastic data reported in February. I mentioned this earlier this morning. Economists were lining up to say there might be more noise than signal in that data. Based on what you've seen in the last week or so, do you think there might be more signal than noise?
Yeah, I think that's definitely the direction the argument's heading now. And look, there were good reasons to think that January was a one-off in terms of warmer weather, particularly on the East. And that being said, I mean, every data point recently has come out reinforces the argument that the labor market remains incredibly resilient. And as long as that's the case, consumers will have the ability to keep the economy going and keep inflation much higher than the Fed is comfortable with, which again means tighter monetary policy, more balance sheet drainage, more financial asset pain. But it sure beats a recession, John. That's the silver lining here, right? There are many silver linings, but one of the key is that, the labor market continues to do extremely well. Nominal GDP is still strong. It's just finally financial assets that are bearing the brunt of a dramatic Fed policy shift.
Troy, well said. If you'd said 12 months ago, and we were talking with Matt Lazzelli at Deutsche Bank about this morning, that the Fed could get somewhere close to 5% and unemployment would still be at 3.4, and Mike McKee claims would be at 200K. Mike McKee, the data this morning, impressive.
It reminds me of one of those Jamie Lee Curtis slasher movies where she's walking around and the music is up and she opens the closet and you're expecting somebody to jump out and nobody ever jumps out yet. We're waiting for that with the jobless claims. 194,000. The expectation was for 200, and that is extremely low. Look at this chart here. Claims always go up before a recession. So if we're going to have a recession, we are not getting there. I left out the 2020 recession because the distortion was so great with the jobless claims, but every other time, and we're not seeing that. So what's going on? Well, in the minutes yesterday, the Fed did discuss it on February 1st and how low they were, and they said that some contacts appeared keen to retain workers because of their recent experiences of labor shortages and hiring challenges. We've talked about labor hoarding, and that does seem to be going on. They also worried about the inflation numbers. Of course, they didn't have the same numbers that we have today, but a number of participants observing that a policy stance that proved insufficiently restrictive could halt recent progress in moderating inflationary pressures. That appears to be what's happening. We got that number today, the core PCE quarter-over-quarter number higher than it was in the prior quarter, in the first number rather, 4.3%. And you can see the forecast for tomorrow. We're expecting the January PCE inflation numbers to rise significantly the way the CPI did and tell us we still have an inflation problem.
Mike, can we talk about leadership at the Federal Reserve as well? I'm sure you saw that report from the Wall Street Journal yesterday. The White House mulling 2 economists from the Obama administration as candidates to become Brainerd's successor as vice chair. What do we know about them?
Well, Janice Eberly is an associate dean at the Kellogg School of Business at Northwestern University, and Karen Dinan is at the Harvard Kennedy School. Both were the chief economist at the Treasury Department during the Obama administration. Dinan followed Eberly in the role. Dinan spent 16 years at the Federal Reserve before going to Treasury. Eberly, basically an academic, was at MIT and Wharton before she went to Northwestern. So they're well known on the circuit. They're well-respected economists, probably not a lot of difference between the two. This report yesterday, or the journal report based on an ISI report that they are under consideration, plus Seth Carpenter, who is at Morgan Stanley. So the administration deep into the search for someone to replace Lael Brainerd right now.
We'll keep asking Seth about that. I'm not sure he's going to reply anytime soon. Mike, are we going to go through all their previous work and make calls about whether they're doves or hawks before they're even nominated to be vice chair?
We are not, but I'm sure people are. There'll be a lot of questions about how they match up with Lael Brainerd, because she was seen as something of a dove, counterweight to the more hawkish members of the committee, and someone who sort of focused on the impact of monetary policy on the average person, the average worker. And so I'm sure members of the Senate who are going to be considering this will be wanting to know which one of them, whoever is chosen, what their views in that area are.
Mike McKee, thank you, sir. As always, Troy, I want to come to you on just how high the bar is, do you think, for a 50 basis point move from this Federal Reserve?
Yeah, right now it's pretty high. I mean, obviously we're trending in that direction as every data point comes out. But, you know, once you downshift from 75 to 50 and 25, you know, it takes quite a bit of political will to move that back up to 50 basis points. And obviously that's been a trial balloon so far that's been floated. But if we continue to see strong data between now and March, that's now entirely possible. And then, you know, more to the points we've talked about in the past, I mean, you're now talking about 5.5% peak rates, if not higher, and that's going to be held there for quarters and quarters, not months and months, unless there's a material degradation in the labor market. And to your point before, there's just no evidence, and no one would have guessed that 12 months ago. If you had said to anybody that we're going to have this degree of tightening, this much weakness of growth overseas, this big a drop in the housing market, no one would predict claims to be under 200K.
I couldn't agree more. So when you look across the curve and you're now thinking about quarters and not months,
yes,
where do you want to be? I can get 5% on 6 months. I can get a 2-year at 470, a 10-year at 395. Where would you want to sit with that in mind?
Yeah, so if you have to take directional duration risk, you certainly want to favor the short end of the curve, right? You're just not getting compensated enough at the far end of the curve for what we expect to be, you know, continued, at least short-term pressure in the back end. But more directly, John, what we favor right now are yield curve steepener positions where you're not taking directional duration risk, and you also have very asymmetric risk reward based on history about how much more inverted the yield curve can possibly get from here, because we're right around 75 basis points. It's unlikely we go to 130 or 150, but we could certainly go to 100 or 105. And over time, and by time we mean the next several years, you should have a curve that normalizes, at least goes to flat, and then potentially re-steepens to 120 to 150. We think that's a much better way of playing a normalization between nominal GDP and real GDP than being long equities at 18 times forward earnings, or being very long speculative credit at 350 to 400 over.
That's the challenge, Sarah. The challenge from the bond market to the equity market. I understand the income argument. Sarah, how do you anticipate the bond market's going to correlate with equities going forward from here?
Been so all over the map that it really has been a difficult thing because historical correlations haven't really worked very well. And if you think about the fact that the unusual situation of coming out of pandemic has made all of these data points very unusual, including the labor market. I mean, if you just think about the fact that Home Depot and Walmart are talking about paying more, even in a strong labor environment where other people are letting people go, it tells you that there is some real strength there. And I think that, I mean, we favor the short end for clients right now because 5% is very attractive in the near term while you see what happens in the equity markets, right? So you want to see some sort of a balance. But I am sort of amazed at the equity markets at 18.2 times with the short end of the bond yields right now where they are. It just seems like there is an imbalance, and it's, who's right, credit or equities? And generally speaking, credit tends to get it right more than equities do, but we'll have to see how that plays out going forward.
Sarah, there's been plenty of surprises the first few months of 2023. One of the surprises has been the leadership from tech. Now, maybe looking at positioning alone, maybe that wasn't a surprise for a lot of people, given how they performed in the last 12 months. The leadership last year and the year before came from energy. Sarah, you like that part of this equity market. Do you still like it?
I still like that part of the equity market. I mean, there's some really up and down situations that are going on with commodities, particularly natural gas right now, especially in the United States. And certainly this very warm winter has made what is normally a weather-driven trade, or at least has a weather component, one that has really not had much of a weather component. And I think that Europe was very lucky in the fact that we had a mild winter, because they had some real challenges, and they're going to have some real issues going into next year. So there will definitely be some volatility there, but longer term, we do think that there is some legs in this energy situation, especially because you've had several years of a lack of investment. And I don't think that we run the tail out on hydrocarbons quite as quickly as politically we seem to be talking about doing.
Well, you mentioned Europe. They've got a problem with core CPI as well. Record high. Euro dollar this morning at 106.10. Saw a 105 handle yesterday and today for the first time since the early part of 23, the first week of January. Troy, I wanted to talk to you about real estate as well, both commercial and residential. Looking at housing prices, dropping from a peak last May. This is a median US home sale price of $433 last May, $383,000 last month. That's residential. Let's talk commercial. There was one story in the last 24 hours that I'd love your response to, Troy. It was an office landlord controlled by PIMCO defaulting on about $1.7 billion of mortgage notes across 7 buildings. The buildings, San Francisco, New York, Boston, Jersey City, New Jersey, owned by Columbia Property Trust. Troy, what's your read on what's happened there, and how would you like to take exposure or not across that sector?
Yeah, so we'll start with residential. I mean, it was really no surprise that after a 35 to 42% surge in home prices, as mortgage rates moved up so dramatically, you know, affordability got back originally to the record lows of 06 and then dropped even further, that the housing market finally peaked. And, you know, when you look at where mortgage rates are and affordability versus income now, you know, nothing like a GFC, 35, 40% peak to trough, but probably a 20 to 25% peak to trough. So there you want to favor cash flows that benefit from home price declines, particularly interest-only securities, and not take residential credit risk, which is very different than most of the post-GFC period where that was so attractive. Now, moving over to commercial, you know, there's no doubt that you want to be in the senior part of the capital structure right now. There's much more price downside to come in certain sectors. Ultimately, you're getting a better yield in senior mortgages than you are cap rates. So you got to be in the top of the capital structure. And then in terms of major metro office, look, the best framework to think about this is it's going to be a repeat of the slow motion train wreck that we had in bricks and mortar retail from really 2011 through 2021. And there's finally light at the tunnel. This is going to be a multi-year valuation adjustment. And, you know, it's really hard to repurpose major metro office into multifamily. It takes tremendous capital investment, and it's going to require some public-private partnership. So we're going to see those losses bleed out, you know, over the next, you know, 5, 7, 10 years to primarily equity holders, where many will be wiped out, but they will leak into debt to some extent. So, you know, when you're thinking of lending strategies, you just want to make sure that you don't have an overabundance of exposure to major metro office, you know, Seattle, San Francisco, Chicago, New York, and DC as well, because the federal government's shrinking their footprint there.
Troy, you know what happens? People mention real estate and their mind goes back to what happened in 07, 08. Yeah. Are you saying that ultimately then this is going to be something that plays out over a long period of time, not all at once with a big bang?
Yeah, so the difference now, right, is we don't expect nearly the same degree of price declines for a variety of reasons. 2, the banking system is just so much better capitalized. We have 50% more Tier 1 capital. We have over $3 trillion of excess reserves still. So there's tremendous loss absorption capacity. And then equally important, you know, underwriting standards prior to the GFC and, you know, from really 04 to 06 completely collapsed. And they stayed incredibly tight this entire cycle. So you didn't see the rather poor underwriting in both commercial and residential real estate. So we think this is more of a valuation adjustment, a healthy adjustment, where there will be losses taken in the equity part of the capital structure, but the vast majority of debt securities should be relatively safe. That being said, you know, if you look at Ginnie in particular in the agency market, you know, they were doing higher LTV loans, so there could be some losses at Ginnie, but they should be manageable.
Hey, Troy, appreciate it. As always, Troy's perspective on what's happening there. Troy Gersky alongside Sarah Hunt. To the both of you, thank you. Your equity market pushing a little bit higher, bouncing back from 4 days of losses on the S&P, up right now by 0.7%. The Nasdaq up more so. Let's get some individual movers. We can do that with Abby. Hey, Abby.
Hey, John. Well, one reason that we do have that Nasdaq popping higher, outperforming the best day since last Monday, all about NVIDIA. This move is stunning to the upside for the chip maker. It's up about, at this point, really at pre-market session highs, up nearly 13%. It's all about the forecast. They put up a good quarter, too, beating top and bottom line estimates. But for this current quarter, they are forecasting $6.5 billion versus the estimate of $6.35 billion, and it has everything to do with their bet on AI processors. As for other earnings movers, eBay and Alibaba, well, eBay, there was a small beat, the outlook disappointing, so you can see those shares are down 5.5%, also given the drop in active users. This is the 7th quarterly drop in a row. And then Alibaba, a big adjusted earnings beat. John, this is amazing. They put up $19.26 in earnings on a single quarter, about 16% better than the estimate. It seems as though Alibaba and China Tech popping on the day.
Abby, thank you. Want to watch into the opening bell coming up. Secretary Yellen striking an optimistic tone.
It's fair to say that the global economy is in a better place today than many predicted just a few months ago.
That conversation up next.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
It's fair to say that the global economy is in a better place today than many predicted just a few months ago. In the fall, many were worried about a sharp economic slowdown across the world. The challenges we face are real, and the future is always uncertain. But the outlook has improved since we gathered in the fall.
Secretary Yellen there, delivering remarks at the G20 finance meeting over in India, sounding optimistic over the economy while reiterating calls to support Ukraine.
We will stand with Ukraine in its fight for as long as it takes. We commend our allies for stepping up their direct assistance. We have made clear that providing material support to Russia or assistance with any type of systemic sanctions evasion would be a very serious concern to us.
The secretary also warning countries about helping Russia evade sanctions. This as Bloomberg finds millions of barrels of sanctioned Russian crude are being switched between shippers in the middle of the ocean. Team coverage starts right now with Emily Wilkins in DC, Julian Lee over in London. Morning, Emily.
Good morning, John. Well, definitely, Secretary Yellen was able to not only go and say that she has a better outlook right now for the global economy, but also show that the U.S. is having the really resilient domestic economy and showing that the U.S. right now, they've been able to keep the job market high. They've been able to keep things going. At the same point, there definitely is a concern, a continuing concern about Russian sanctions, Russian oil. We do have Congress looking at various bills to try and help the U.S. be energy independent. One of those, if you remember, it's that permitting reform from Senator Joe Manchin. He's back talking with Republicans about it. He's hoping that that would expedite the ability to do the drilling and to get more fuel into the U.S. economy.
Julian Lee, I wanted to draw people's attention to the story you've put together on these Russian barrels of crude. Julian, just walk us through what you found.
Yeah, well, I mean, there's the Bay of Lakonikos off the southern Peloponnese in Greece. It's always been a popular area for transferring cargoes from one ship to another. It's relatively sheltered. And what we've seen this year so far is about 20 transfers of cargoes of Russian crude. More than that, or additional to that, transfers of refined products as well. It's not clear that this is particularly sanctions evasion because we're able to see it happening. But one thing that's very clear is the Spanish government has taken a very tough line on this of similar transfers off their North African territory. Greece is letting this go at the moment and doesn't seem to be wading in.
Amazing story. Julian, thanks for it. Fantastic read. Julian Lee there, Emily Wilkins. Up next, your morning calls.
Why'd you do this project? Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat, are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Let's get you some morning calls. First up, Morgan Stanley upgrading Intel to equal weight, seeing limited downside after cutting its dividend. BofA downgrading Lucid to neutral, seeing signs of weakening demand. And finally, Truist raising its price target on Etsy to $150, calling the company's forecast appropriately conservative. That stock is up by 3.8%. Coming up, gearing up for what Jonathan Golub of Credit Suisse calls stagflation light. That conversation up next with futures rebounding. We're up 0.7%. The opening bell up next.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story. Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
24 seconds away from the opening bow this morning. Good morning to you all. Going into that open, futures positive by 0.75% on the S&P, on the Nasdaq up by 1.28%. We'll talk about Nvidia, the why behind that move, in just a moment. 4-day losing streak on the S&P, looking to bounce back from that at the opening bow. There's the opening bow. Switch on the board and get to the bond market. Yields bouncing off the back of jobless claims coming in below expectations. A downside surprise. That's what we call the right kind of downside surprise. Yields fade from 395 at the high, 396, 397-ish, 392.54 right now on a 10-year, up by not even a basis point. In the FX market, euro-dollar from 105 to 106, positive not even 1/10%. Core CPI in the Eurozone, record high, and crude looking to bounce back as well, 75.50 on WTI. We're positive there by about 2%. 25 seconds into the session, equities look like this on the S&P, up 0.75% on the Nasdaq, up by 1.1%. Consumer discretionary year today, absolutely flying on the S&P 500, up by about 13%. Online retailers, eBay, Etsy, Wayfair, all reporting earnings this morning, delivering a mixed bag of results amid a challenging macro environment. Abby has more.
Hey, John. Well, this is interesting because we do have on the day the consumer discretionary space actually flat, and it has to do with some of that declining action from specifically eBay and Wayfair. So it was a bit of a mixed bag here relative to eBay. They put up a small beat, but the outlook disappointed, and they also had declining users. Now, relative to Wayfair, down 8%. On the year, up 50%, though. So the quarter was priced to perfection. It didn't come in that way, a wider loss. They also saw a decline, 19% decline on a quarter-over-quarter basis in users. Now, relative to Etsy, a bit of a more positive view there. Mixed quarter, they beat sales. Profits were down, though. Analysts liked it. Price targets raised. And you can see there the sales growth for Etsy, impressive, up 13%. But for Wayfair and eBay, not so much. And relative to those declining user bases, eBay, their declining user base has been over the last 7 quarters in a row, but they've also, for the last several fourth quarters of each year, they've seen a decline, and that's the big December quarter, so it seems as though eBay are folks, consumers, users relying on eBay less during that all-important holiday quarter.
eBay down 5%. Abby, thanks for that. You want to move? Here's a move. Nvidia up more than 12% in the early part of the session, giving an upbeat forecast with its push into AI, helping to offset weakening PC demand. The CEO saying this: it's a wake-up moment for the capabilities of AI. This is really where we can be of great value for the industry. Isabel Lee has more. Hey, Isabel.
Hi, John. It's really all about guidance when it comes to earnings, and investors are rewarding NVIDIA for that. The company gave a bullish outlook for the first quarter on the back of a strong AI push that it said would offset the sluggish demand in personal computer chips. So NVIDIA said that it expects first quarter sales to hit $6.5 billion. That's more than the fourth quarter and slightly above consensus. Obviously, Wall Street is cheering the forecast despite overall revenue declining 21%. As you can see on the chart, it's the second decline in 13 quarters. Still, shares are jumping today, and it's already the best performer year to date with the S&P Tech Index just slightly behind Meta. And perhaps to the point you made earlier, it's helped by the recent AI view. We have the CEO and co-founder Jensen Huang saying that, interest in ChatGPT has opened the eyes of business leaders to the power of artificial intelligence. And if you're wondering why the holiday season didn't do so well, it's because gaming fell by around 46%, but it did top earnings estimates average still, though. John.
Isabel, thank you. What a move year to date and on the session as well. And worth considering, it is the fourth biggest weighting on the NASDAQ 100. That's behind much of the move we're seeing this morning. About 3 minutes into the session on the S&P, we're up by 0.8%. The broader NASDAQ composite up by 1.1% on the NASDAQ. Let's stick with tech. Shares of Alibaba surging after delivering better than expected results. The company's CEO expecting China's reopening to fuel near-term growth, saying this: all of our merchants expressed a strong desire to get back to business. We expect that this recovery will continue. Everything is now quickly getting back on track. Katie Greifer with us with more. Hey, Katie.
Hey, John. Well, we're already seeing a recovery on the earnings front. If you look at profits, there was a big beat there. That measure surged about 69% to about $6.8 billion. And of course, it's partly thanks to cost-cutting measures. We got that in the form of layoffs last year to the tune of about 19,000 jobs. Now, those were designed to boost, quote, high-quality growth last year, and that continues to be the focus for Alibaba. They're prioritizing profitability rather than new business expansion. And today's rally, we're talking about 3.5% right now. It's helping to further rebuild Alibaba's market cap. Now, since October's low, Alibaba has added about $84 billion back to its value, which currently clocks in at about $250 billion. And as you can see, that rebound is dwarfed by Tencent, but still comfortably ahead of rivals such as Pinduoduo, such as you can see Baidu there as well. And that's the case even with Alibaba's relatively rough month. Again, we have shares up in a big way from October, up about 50% from that low, but that gain was about 90% at its peak. And it's worth noting that Alibaba is still down about 10% over the last year, John, so a bit of a hole there.
It's funny, I picked up the exact same chart as Katie. Katie, thank you for that. So off that October low, we're still up by about 54%. Including today's move. But to Katie's point, the high at the end of January, we were off that low by something like 91%, just a phenomenal move. For the broader market then, 5 minutes in, we do get a bounce. We snap the 4-day losing streak, at least for now, on the S&P up 0.7%. Here's the take from Jonathan Golub at Credit Suisse. This is what he has to say. The best way to describe this environment is stagflation light. I'll get to that term in a moment. 3 to 4% inflation with slow growth but abundant jobs. It looks nothing like the 70s, but it's a challenge for equities. Jonathan Golub, I'm pleased to say, joins us right now. So, John, let's go there. Stagflation light. I see great growth right now. What do you see in the future?
Well, if you look at the consensus based on the Bloomberg survey of economists, we're looking at 60 basis points of GDP this year. And next year, it gets a little bit better, but not a lot. And there's two things that are dragging on the economy. The first one is if you're a business that wants to expand, you can't find workers. And that's a headache. And the second one is that the Fed is tightening enough to really slow down the economy and take some air out of the tires, but not enough to throw us into recession. Now, John, last time that you and I talked, we said, what would guys like me want to see more than anything else? You crash the economy, you have a real recession, you have a big V-shaped bounce, and it's a cycle that we know exactly how to think about. This is much more challenging.
Well, talk to me about what that means for discretionary. That's the one a year to date, 13% year to date on the S&P. How do you think about that, John, at the moment? Up 13%. Yeah. If we go to your world of 3 to 4% inflation, slow growth but abundant jobs, where does that leave discretionary?
It's actually my favorite sector for this type of environment. Just think about what the consumer is facing. Last year, wages went up 3 to 4%, but inflation, CPI averaged 8. So the average American went to the store, got a raise, and realized it didn't go as far as he wanted. This year, he's getting a raise of 5 to 6%. If you're a retiree, your cost of living adjustment on your Social Security or government pension is up 8%, but inflation is expected to be under 3% at the end of the year. So the consumer is going to feel surprisingly empowered in this environment because wages are running hotter than inflation, or they will be throughout the course of the year. The other thing is, with jobs abundant, you have this really golden environment for consumers. It's one of the reasons why that both the University of Michigan and the Conference Board consumer confidence surveys have been rising steadily since last June, because last year was really a year where companies won over labor. And this year is one where labor wins out over corporate profits and companies. So there's a real shift in the in how things are playing through.
Well, John, let's talk about the winners and the losers around that story. The airlines year to date, American Airlines up 22%, United up 32%, Delta up by close to 15%, 14% higher. Do you see reasons for that to continue?
Well, first of all, as I said, I think the consumer will increasingly have more discretionary income. A lot of people are talking about the need for consumers to tap their credit cards and how much further can that go. But the real issue here is that wages are much stickier and staying at a higher level, and the general level of inflation is coming down. So what does someone do who has extra cash? They've already paid for their food. They've already paid for their health insurance and their rent. They get on a plane and they go someplace. As a matter of fact, I think the group that looks the most that's the most empowered in this environment are seniors that have a pickup in their cost of living. And what are they likely to do? They're likely to go, on a river cruise gambling, or they're likely to go, on something where, something like, like I said, like a cruise, where it's particularly well geared for them. And if you look at how the cruise lines have done this year, they've just been on fire. And I think that this is part of that theme.
Labour pressures, we've talked about that. You've mentioned it. So Labour feels like they have the power. The markets might be compromised. Home Depot, Walmart early this week. Home Depot basically warning that there's going to be some labour pressure that might hit margins. That was the take from a lot of analysts. John, are they the losers in your world?
Yeah, I mean, if you think about this the way an economist would describe it, is you have a certain amount of economic growth in dollars. In certain years, it goes to the owners of capital. In certain years, it goes to labor. For the last 25 years, the owners of capital, companies, have been the big winners, and labor has stagnated more. The next year or two, it's going to be the opposite. And so, this from a policy perspective, people have wanted the economy to rebalance so that the average American sees their own situation moving ahead in the same direction as the stock market. And it hasn't happened that much in the last 25 years. But in this environment, that's exactly what's happening. Labor is coming out ahead. And I haven't really heard policymakers talk about this as a win, but I think it probably is.
It would be a win if they talked about it, but they don't really talk about it that much. I think that's the objective, the ultimate objective. So, John, we live in a world where the economy might look good and the market might look bad. Is that the takeaway?
Yeah, I think it is, John, is that the corporations, first of all, in this environment where the consumer feels pretty good, you don't get a recession. So that's one of the real positives for the stock market since the beginning of October, is that the likelihood of a recession in the picture I paint is much lower. And if you don't have a recession, it's truly not bad for the stock market. On the other hand, corporate profits, the expectations for how they're going to do in 23 and 24 continue to fall. And it's not a revenue problem. It's not that people aren't spending. It's that corporations are getting squeezed on profit margins. And that's going to be the story. This earnings season, earnings are up over 5%. Margins are down 9%. That's directionally what I think the rest of the year is going to look like. Sales good, profits weak, and people are going to be really confused about that, but it's all about wages.
So, John, right now in the S&P, 4,016, 4016. Your year end is 4050. Given the risks we've talked about, given the weightings of the S&P 500, each company is going to experience these themes in different ways. A risk skew to the downside?
I think the overall market's probably going to be flattish. And it's really interesting how well the call is working out. And, you know, in the beginning of October, when we put out this 40-50 target, our expectation was the stock market would move very rapidly higher as inflation settled down a little bit, as recession risks eased. But that once we got into the beginning of this year or the middle of this year, that the upside was going to be capped, and I think that that's probably true. But there are winners. So we're talking about winners and losers. Defensive stocks, those that do the best when we go into recession. If you're not going into recession, you don't need to be in consumer staples or utility or healthcare. So I think that they're laggards, and they haven't done all that well, generally speaking. Consumer discretionary, even though the overall economy is sluggish, if the consumer feels better, those names do pretty well. And you were talking about the airlines, we're talking about cruise lines. Those do fine. Tech companies are really struggling, and that's kind of a somewhat different story. But I would love to be buying tech right now, but the earnings picture there is somewhat challenged, especially at the biggest tech companies.
And so many people have been doing just that so far here today with big runs already. John, this was wonderful just to get a breakdown of your framework for thinking about this market. Jonathan Golub there of Credit Suisse. Year to date, the Nasdaq up by close to 11%, on the S&P 500 up close to 4.5%. Coming up, more cuts in tech and finance.
We know that there are structural things that have happened to the labor market that aren't going to be easily fixed. Now, on the one hand, that's good for consumers, but it's also not good for the consumers who end up losing their jobs because margins are getting pinched.
This time, it's Wells Fargo and Meta. That conversation up next.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
One of the things we've learned in the course of our episodes about trucking is that there's like two distinct trucking markets, and there are the port drivers, and then there are the long haul over the road drivers. And you were talking about this sort of like culture of independence, and people get into trucking, you know, there might be a reason that they're not sitting behind a desk in some email job. But is that true for the, like, is the culture of port trucking the same as the over-the-road, like, convoy style? They made movies about it. Like, is that the same? Because my understanding, or at least my impression, was that the port drivers were more immigrants and people who had fewer opportunities in the first place. And also, and sort of related to that, and you know, you mentioned that there have been these protests in California against AB5. Are the people who are coming out to protest them, do we have reason to think that they're like representative of the broader trucking industry, or is it just like a certain group subset within that space who is particularly threatened by this?
You know, it's funny. I have reached out to truck drivers kind of like in my network to ask what they think about 85. Most of them are long haul drivers. Many of them are based in the Midwest or, you know, the Southeast. And when I asked them, like, oh, what do you think of this law? They were like, I don't care. It's in California. I don't live in California.
The moment news breaks, no one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
Wages are going to continue to be pressured by wage growth for a bit longer. And we know that there are structural things that have happened to the labor market that aren't going to be easily fixed. Now, on the one hand, that's good for consumers, but it's also not good for the consumers who end up losing their jobs because margins are getting pinched. I think at the end of the day, that's one thing the street is struggling to understand is what is the new normal in terms of labor.
So it's hard to get your hands around this. We had claims earlier this morning at 200,000, sub 200K. But just in a couple of industries, finance and tech, the layoffs keep piling up. Wells Fargo cutting more than 500 jobs in its mortgage unit, adding to the thousands of cuts from last year. In big tech, the Washington Post reporting in the last 24 hours that Meta plans to reduce and reorganize thousands of workers. Shonali Basak joins us now here in New York alongside Mandeep Singh. Mandeep, first to you, the story we're familiar with now in tech, more cuts.
Well, so and it's not surprising because tech companies have high fixed costs. I mean, if you keep aside the Uber, Lyft, and the ride-sharing companies, most of the times they have a very high operating leverage because, you know, in times when revenue growth is strong, the fixed cost model works quite well. The problem is when the revenue growth starts to taper down, which is the case, you know, with all the consumer tech companies, the fixed costs become a problem because it shows up in the margin degradation. And that's why you see another round of cuts possibly at Meta. And I don't think it's good for, you know, the morale or just retaining talent. So I do see as a problem when companies have multiple round of cuts.
Mandeep, given the excess hiring we saw in the pandemic, are we closer to the beginning of this or the end?
Well, so I would say we probably have a few quarters to go simply because in the case of Meta, it looks like a structural problem. We saw that, you know, with Apple changing its policies around privacy, that hurt their ad pricing. Now they're tinkering with a subscription model, you know, charging creators for using the tools on the platform. And those structural issues take time to resolve. I mean, maybe Meta may not be able to get to that 20-25% top line growth level again. And that's when they have to think about how they can right-size the costs. And that's what they're doing here.
Shonali, in tech, it's thousands, tens of thousands. It's far more incremental with these banks. What are you seeing, Shonali?
It's drip by drip, John. And remember, some of this is because of slowing growth, slowing business at many of these firms. You saw that over at Goldman Sachs be part of the case after years of headcount increases. But remember, some of this you have to recognize is also strategy shifts as some of the market fundamentally changes. When you're looking at Wells Fargo and particularly, that's certainly the case. Because not only are the mortgage markets really hammered here, you also have this secular move from the mortgage markets away from the big banks and lending into other places instead. So when they're cutting jobs here, it's not just about boom and bust. It is about changes in the environment itself. The question here then becomes thousands last year, hundreds this year. Who else is yet to come? The mortgage market is a very clear space where there's a lot of pain. You saw those cuts at JP Morgan as well. But do those cuts become deeper elsewhere? It's a very close thing to watch after watching Bank of America announce hundreds as well after holding on for dear life for the last couple of weeks and trying to preserve those jobs. Does it get deeper?
It's incremental, but we're seeing it more and more. Shonali, thank you. Alongside Mandeep Singh, to the both of you, just fantastic. One name I wanted to pick out, Tesla. It's up in early trading by about 1% so far, last time I looked. Year to date, it's absolutely flying, up by 65%. The latest news from the company, the EV maker announcing it will set up its global engineering headquarters in Palo Alto. This coming after years of Elon Musk essentially bashing the state of California. Bloomberg's David Welsh joins us now with more. David, what's the latest?
Yeah, so they've named California as their engineering center, which isn't really a huge surprise, except that Elon has been fighting with the state, criticizing the state. He moved the headquarters of the company to Austin, Texas, and has expanded the footprint there. But Tesla still has about 46,000 employees in California. And if you look at it, if you're trying to develop electric vehicles, you're trying to develop self-driving vehicle technology, the talent base is still in the Bay Area, Silicon Valley. So if Elon wants to continue developing all of these things, and he does, he's got to have an engineering base there because that's where the people live, and it's going to be tough to get them all to move to Austin. So I think this is about talent and about having an existing base already in the state.
David, do you think that story is changing, though? We hear that talent argument a lot, but ultimately, given the hybrid nature of working for so many people, particularly on the West Coast, is that changing at all?
It is, and Austin has a pretty good talent base itself for technology. But when you're looking at code writing, things like that, I think with this announcement, he's got, let's say, big big footprint in each state. So people can work in Austin, people can work in California, they can collaborate virtually, they can fly back and forth. It's not a long flight. I think he's probably playing both ends of it here, which is a smart thing to do because you do have talent pools in both areas.
True. Good point, David. Thank you. Stock's up by about 0.7% now. The broader market, about 23 minutes into the session, is up 0.8 on the S&P and the Nasdaq, doing okay, better than okay, up 0.9% with a sector price action. Here's Abby.
Well, we have very strong action, not surprisingly, today, John, with that S&P 500 up for the first time in 5 days, and it has everything to do with NVIDIA and big tech. NVIDIA up 13%, the best day of the year. Technology, the best sector, up 1.76%. We have a few other sectors up about 1% or more. The only sector down, communication services. This as Netflix is down about 3% on a report that they are cutting subscription costs in many countries. As for the last month, well, because of the move that we're seeing higher for technology, despite rates going higher, discretionary and tech higher, utilities and energy lower, a little bit of a flip of last year.
The broader market higher. Abby, thank you for that. Up 0.9%. Your trading diary up next.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Attempting to break the longest losing streak of the year so far in the S&P. Over the previous 4 days, we were down every single day to a total of about 3.9% into negative territory. We bounced back from that, up 0.9 on the S&P, on the Nasdaq, up by 1.3. That's the price action. Here's the trading diary. What you need to be looking for. Commerce Secretary Gina Raimondo speaking at noon Eastern Time. Fed speak from Bostic daily. Then Jefferson, Mester, Bullard, Collins, Waller, all speaking on Friday. Plus new home sales, PCE deflator, and income and spending numbers to round out the week. That rounds out this morning for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg TV.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus, and I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found